Thank you for your interest in watching this video. Each of the practice questions you see adheres to the examination format and difficulties. Please note that the questions will not appear 100% the same in the real exam, as we need to respect their copyright. However, the carefully crafted practice questions and the detailed explanations right after each of the questions will help you prepare for the exam effectively. Please note that we spend thousands of dollars to create videos like this, hiring professionals in specific areas, and filtering useful practice questions that are relevant to the exam, all completely free for you. Why? Because we understand that it's difficult enough to prepare for an exam and to pay for the examination fee. All we ask for is 2 seconds of your time to subscribe to this video, click the like button, and let us know if the video is useful to you by commenting down below. It means the world to us. Many thanks and wish you success in your exam. Leave a comment below if you want any specific exams covered. Question 1. What is the key difference between term life insurance and whole life insurance policies? A. Term life insurance policies accumulate cash value over time. B. Whole life insurance policies offer coverage for a specific term, typically ranging from 5 to 30 years. C. Term life insurance policies provide coverage for the entire lifetime of the insured. D. Whole life insurance policies do not require premium payments. The correct answer, C. Term life insurance policies provide coverage for the entire lifetime of the insured. Explanation. Term life insurance policies provide coverage for a specified term, usually ranging from 5 to 30 years, during which the insured pays premiums. If the insured dies during the term, the policy pays out the death benefit to the beneficiaries. However, if the insured outlives the term, the coverage ends, and there is no payout. On the other hand, whole life insurance policies provide coverage for the entire lifetime of the insured, as long as the premiums are paid. These policies also accumulate cash value over time, which can be borrowed against or withdrawn. The cash value grows at a guaranteed rate and is tax-deferred, providing a savings component in addition to the death benefit. It's important for insurance agents to understand this difference because clients may have different needs and preferences when it comes to the duration of coverage and the potential for cash value accumulation. Question 2. Mr. Smith is considering purchasing a life insurance policy and is concerned about inflation eroding the value of the death benefit over time. Which type of life insurance policy would best address his concern? A. Term life insurance policy. B. Whole life insurance policy. C. Variable life insurance policy. D. Universal life insurance policy. The correct answer, D. Universal life insurance policy. Explanation. A universal life insurance policy offers flexibility in premium payments and death benefits, as well as the potential for cash value accumulation. One of the key features of a universal life policy is the ability to adjust the death benefit and premium payments over time. This flexibility allows policyholders to address concerns such as inflation by increasing the death benefit to keep pace with rising expenses. Additionally, universal life policies often offer indexed or variable interest rates for cash value accumulation, providing the opportunity for higher returns compared to traditional whole life policies. However, it's important to note that universal life policies also come with investment risks, as the cash value may fluctuate based on market performance. By choosing a universal life insurance policy, Mr. Smith can mitigate the impact of inflation on the value of his policy's death benefit while also gaining the potential for cash value growth. Question 3. Ms. Rodriguez is interested in purchasing a life insurance policy but is unsure whether she should opt for a participating or non-participating policy. What is the primary difference between these two types of policies? A. Participating policies provide coverage for a specific term, while non-participating policies offer coverage for the insured's entire lifetime. B. Participating policies pay dividends to policyholders, while non-participating policies do not. C. Participating policies have higher premiums but offer guaranteed cash value growth, while non-participating policies have lower premiums but no cash value accumulation. D. Participating policies require medical underwriting, while non-participating policies do not. The correct answer, B. Participating policies pay dividends to policyholders, while non-participating policies do not. Explanation. Participating life insurance policies are typically issued by mutual insurance companies and entitle policyholders to receive dividends. These dividends represent the insurer's share of the company's profits, which are distributed to policyholders as a return on their investment. Policyholders have the option to receive dividends in cash, use them to reduce premiums, accumulate them with interest, or purchase additional coverage. On the other hand, non-participating policies do not pay dividends. Instead, the premiums for these policies are set at a level to cover the cost of insurance and administrative expenses. While non-participating policies may offer lower premiums initially, they do not provide the opportunity for policyholders to share in the insurer's profits. When advising clients like Ms. Rodriguez, insurance agents should consider their preferences regarding potential cash value growth and dividend payments, as well as their long-term financial goals. Question 4. Mr. Thompson is considering purchasing a permanent life insurance policy but is unsure whether to choose whole life or universal life. What is a key difference between these two types of policies? A. Whole life policies offer adjustable premiums, while universal life policies have fixed premiums. B. Universal life policies provide a guaranteed death benefit, while whole life policies do not. C. Whole life policies offer a guaranteed cash value accumulation, while universal life policies do not. D. Universal life policies offer flexibility in premium payments and death benefit adjustments, while whole life policies do not. The correct answer, D. Universal life policies offer flexibility in premium payments and death benefit adjustments, while whole life policies do not. Explanation. One of the primary distinctions between whole life and universal life insurance policies is the flexibility they offer in premium payments and death benefits. Whole life policies typically have fixed premiums and a guaranteed death benefit, meaning the premiums remain constant throughout the policy's lifetime, and the death benefit is predetermined at the time of purchase. In contrast, universal life policies allow policyholders to adjust both the premium payments and the death benefit over time. Policyholders can choose to increase or decrease their premium payments within certain limits, and they also have the flexibility to adjust the death benefit to meet changing needs or circumstances. This flexibility makes universal life insurance attractive to individuals who may have varying financial situations or who want the option to modify their coverage as their needs evolve. Question 5. When considering term life insurance policies, what is a key factor to understand regarding the premium payments? A. Premiums remain constant throughout the policy term. B. Premiums increase gradually over the policy term. C. Premiums decrease over the policy term. D. Premiums are paid only at the beginning of the policy term. The correct answer, B. Premiums increase gradually over the policy term. Explanation. Term life insurance policies typically offer premiums that remain level throughout the initial term of the policy. However, there are certain types of term policies, such as annually renewable term policies, where the premiums can increase gradually over time. This increase in premiums is often due to the increasing risk of death as the insured individual ages. It's crucial for policyholders to understand the premium structure of their term policy to ensure they can afford the payments over the entire policy term. Question 6. Sarah, a 35-year-old individual, is considering purchasing a term life insurance policy. Which of the following factors should she consider when selecting the length of the policy term? A. Her current health condition. B. The number of dependents she has. C. Her financial obligations, such as mortgage payments and children's education expenses. D. The age at which she plans to retire. The correct answer, C. Her financial obligations, such as mortgage payments and children's education expenses. Explanation. When choosing the length of a term life insurance policy, it's important for Sarah to consider her financial obligations, such as mortgage payments, children's education expenses, and any other debts or financial responsibilities she may have. The purpose of a term life insurance policy is to provide financial protection for a specific period, typically covering temporary needs such as mortgage payments or children's education expenses. Therefore, Sarah should select a policy term that aligns with the duration of these financial obligations. Factors like her current health condition and the number of dependents may influence the amount of coverage she needs but are not directly related to the length of the policy term. Question 7. Mr. Smith is comparing different term life insurance policies. What should he consider regarding the renewal options offered by these policies? A. Renewal options are guaranteed regardless of health status. B. Renewal options may require proof of insurability. C. Renewal options are only available for permanent life insurance policies. D. Renewal options are typically more expensive than purchasing a new policy. The correct answer, B. Renewal options may require proof of insurability. Explanation. Renewal options in term life insurance policies allow policyholders to extend coverage beyond the initial term without undergoing a new medical examination. However, it's important for Mr. Smith to understand that some policies may require proof of insurability to exercise the renewal option. This means that the insurance company may require evidence of good health or may adjust the premiums based on the insured individual's health status at the time of renewal. Understanding the renewal options is crucial for policyholders to ensure they can maintain coverage as their needs change over time. Question 8. What is a key difference between renewable term life insurance and convertible term life insurance? A. Renewable term policies allow policyholders to convert their policies to permanent life insurance without evidence of insurability. B. Convertible term policies have fixed premiums throughout the policy term. C. Renewable term policies offer lower death benefits compared to convertible term policies. D. Convertible term policies cannot be renewed at the end of the initial term. The correct answer, A. Renewable term policies allow policyholders to convert their policies to permanent life insurance without evidence of insurability. Explanation. Renewable term life insurance policies allow policyholders to renew their coverage at the end of the initial term without evidence of insurability. On the other hand, convertible term life insurance policies provide the option for policyholders to convert their term policies into permanent life insurance policies without having to undergo a medical examination or provide proof of insurability. This flexibility can be beneficial for individuals who anticipate their insurance needs evolving over time, as it allows them to adapt their coverage without the need for additional underwriting. Question 9. Amy is comparing term life insurance policies and is concerned about outliving her coverage. Which feature should she look for to address this concern? A. Accelerated death benefit rider. B. Guaranteed insurability rider. C. Return of premium rider. D. Waiver of premium rider. The correct answer, C. Return of premium rider. Explanation. To address the concern of outliving coverage, Amy should look for a term life insurance policy that offers a return of premium rider. This rider provides a refund of the premiums paid at the end of the policy term if the insured individual survives the term of the policy. While this rider typically results in higher premiums compared to policies without it, it provides a valuable benefit by ensuring that premiums are not lost if the insured outlives the coverage period. It offers a form of financial protection and peace of mind for policyholders who may be concerned about investing in insurance they may not need. Question 10. Mark is considering purchasing a decreasing term life insurance policy. What is a common scenario where this type of policy might be suitable? A. Providing financial protection for a specific period, such as paying off a mortgage. B. Ensuring lifelong coverage with fixed premiums. C. Offering a death benefit that increases over time. D. Providing a lump sum payment upon the insured's death. The correct answer, A. Providing financial protection for a specific period, such as paying off a mortgage. Explanation. Decreasing term life insurance policies are often used to provide financial protection for a specific period, such as paying off a mortgage or other outstanding debts. The death benefit of a decreasing term policy gradually decreases over the policy term, typically in line with the declining balance of the mortgage or other debt. This type of policy is suitable for individuals who want to ensure that their financial obligations are covered in the event of their death, such as ensuring that their family can continue to make mortgage payments even if they are no longer able to provide income. It's important for Mark to carefully consider his financial goals and needs when selecting the appropriate type of term life insurance policy. Question 11. John is comparing term life insurance policies and is interested in the difference between level term and increasing term policies. Which statement accurately describes a feature of increasing term life insurance? A. Premiums increase over time. B. The death benefit remains constant throughout the policy term. C. The policy accumulates cash value. D. The death benefit increases over time. The correct answer, D. The death benefit increases over time. Explanation. In increasing term life insurance policies, the death benefit increases over time while premiums typically remain level. This type of policy is often chosen by individuals who anticipate their insurance needs growing over time, such as to cover increasing financial responsibilities or to keep pace with inflation. The increasing death benefit provides added protection against the rising cost of living and ensures that beneficiaries receive a larger payout as time goes on. It's important for John to understand the features of different types of term life insurance policies to select the one that best suits his needs. Question 12. Emily is considering purchasing a term life insurance policy but is unsure about the differences between a term life policy with a fixed term and an annually renewable term policy. Which of the following statements accurately describes a feature of an annually renewable term policy? A. Premiums remain level throughout the policy term. B. The policy expires at the end of the initial term. C. Premiums increase annually as the insured ages. D. The death benefit decreases over time. The correct answer, C. Premiums increase annually as the insured ages. Explanation. An annually renewable term life insurance policy offers coverage for 1 year at a time and allows policyholders to renew their coverage each year without evidence of insurability. However, the premiums for this type of policy typically increase annually as the insured individual ages. The increasing premiums reflect the increasing risk of death associated with advancing age. While annually renewable term policies offer flexibility and short-term coverage, the increasing premiums over time may make them less cost-effective compared to fixed-term policies for individuals who need coverage for an extended period. Question 13. Mr. Smith is considering purchasing a universal life insurance policy to ensure financial security for his family in the event of his passing. As an insurance agent, you explain to him the key features of a universal life policy. Which of the following statements accurately describes one of the distinctive characteristics of universal life insurance policies? A. Premiums are fixed throughout the policy's duration. B. Policyholders can choose how their premiums are invested. C. Universal life policies offer a guaranteed minimum death benefit. D. Cash value accumulation is not affected by interest rates. The correct answer, B. Policyholders can choose how their premiums are invested. Explanation. Universal life insurance policies provide flexibility to policyholders in terms of premium payments and investment options. Unlike whole life insurance, where premiums are typically fixed, universal life policies allow policyholders to adjust the amount and timing of premium payments. Additionally, one of the key features of universal life insurance is the ability for policyholders to direct the investment of the cash value portion of their policies. They can choose from various investment options, such as fixed interest accounts, indexed accounts, or variable sub-accounts. This flexibility allows policyholders to potentially earn higher returns based on their risk tolerance and investment preferences. It's crucial for policyholders to understand the investment risks associated with their chosen options, as investment performance directly impacts the cash value and, consequently, the policy's benefits. Question 14. Ms. Anderson has been paying premiums on her universal life insurance policy for several years. Due to financial constraints, she's considering skipping premium payments for a few months. As her insurance agent, what would you advise her regarding the consequences of missing premium payments in a universal life insurance policy? A. The policy will automatically lapse if premium payments are missed. B. The insurer will use the cash value to cover premium payments temporarily. C. Missed premium payments will be deducted from the policy's cash value. D. Policyholders can skip premium payments without any repercussions. The correct answer, C. Missed premium payments will be deducted from the policy's cash value. Explanation: Universal life insurance policies offer flexibility in premium payments, but missing payments can have consequences. When a policyholder skips premium payments, the insurer may deduct the missed premiums from the policy's cash value. If the cash value is sufficient to cover the missed premiums, the policy will remain in force. However, if the cash value is insufficient to cover the premiums, the policy could lapse unless the policyholder makes up the shortfall. It's essential for policyholders to understand the impact of missed payments on the policy's cash value and coverage. Additionally, policyholders should be aware of any grace periods provided by the insurer, which allow a certain period after the premium due date to make payments without penalty. Advising clients on the importance of maintaining premium payments ensures continuous coverage and avoids the risk of policy lapse, which could leave beneficiaries unprotected. Question 15. Mr. Thompson is interested in purchasing a universal life insurance policy but is concerned about the cost. As an insurance agent, you explain the factors that determine the cost of universal life insurance. Which of the following factors primarily influences the cost of a universal life insurance policy? A. The policyholder's age at the time of application. B. The insurer's financial strength rating. C. The policy's cash surrender value. D. The type of investment options selected by the policyholder. The correct answer, A. The policyholder's age at the time of application. Explanation: The cost of a universal life insurance policy is influenced by various factors, but one of the primary determinants is the policyholder's age at the time of application. Generally, younger individuals are charged lower premiums because they are considered lower risk for the insurer. As individuals age, the risk of mortality increases, leading to higher premiums to compensate for the greater likelihood of a death benefit payout. Therefore, securing a universal life insurance policy at a younger age typically results in lower premiums over the policy's duration. Other factors that may impact the cost include the desired coverage amount, the policyholder's health status, and lifestyle factors. It's crucial for individuals to consider these factors carefully and purchase life insurance coverage that aligns with their long-term financial goals and needs. Additionally, while the insurer's financial strength rating is important for evaluating the company's stability, it doesn't directly determine the cost of an individual's policy. Question 16. Mr. Rodriguez is considering surrendering his universal life insurance policy due to financial difficulties. As his insurance agent, you explain the implications of surrendering a universal life policy. Which of the following statements accurately describes a consequence of surrendering a universal life insurance policy? A. Surrendering the policy releases the policyholder from all financial obligations. B. Policyholders can receive the cash value of the policy without any tax consequences. C. Surrender charges may apply, reducing the amount of cash value received. D. Surrendering the policy guarantees a portion of the premiums paid will be refunded. The correct answer, C. Surrender charges may apply, reducing the amount of cash value received. Explanation: When a policyholder decides to surrender a universal life insurance policy, surrender charges may be applied by the insurer. These charges are subtracted from the policy's cash value, reducing the amount the policyholder receives upon surrender. Surrender charges are typically highest in the early years of the policy and decrease over time. It's essential for policyholders to review their policy documents and understand the surrender charges associated with their specific policy. Additionally, surrendering a policy may have tax implications. Any cash value received in excess of the premiums paid into the policy is generally considered taxable income. Policyholders should consult with a tax advisor to understand the potential tax consequences before surrendering a universal life insurance policy. Question 17. Mr. Thompson has held a universal life insurance policy for several years and is considering taking out a policy loan to cover unexpected expenses. He wants to understand how policy loans work and their implications. As his insurance agent, you explain the mechanics of policy loans in universal life insurance. Which of the following statements accurately describes the characteristics of policy loans? A. Policy loans do not accrue interest and are tax-free. B. Policy loans reduce the policy's cash value and death benefit. C. Policy loans are repaid by the insurer upon the policyholder's death. D. Policy loans are limited to the amount of premiums paid into the policy. The correct answer, B. Policy loans reduce the policy's cash value and death benefit. Explanation. Policy loans allow policyholders to borrow funds from the cash value of their universal life insurance policy, using the policy itself as collateral. While policy loans can provide liquidity and flexibility, it's essential for policyholders to understand their implications. When a policy loan is taken, the insurer reduces the policy's cash value by the amount borrowed, and interest accrues on the outstanding loan balance. If the loan is not repaid, the outstanding balance plus accrued interest will be deducted from the death benefit payable to beneficiaries upon the insured's death. Failure to repay policy loans can diminish the policy's cash value and ultimately reduce the amount of death benefit received by beneficiaries. Policyholders should carefully consider the impact of policy loans on their long-term financial plans and explore alternative borrowing options if available. Question 18. Ms. Nguyen is interested in purchasing a universal life insurance policy but is unsure about the different premium payment options available. She wants to understand the differences between level premium and flexible premium payment structures. As her insurance agent, you explain the characteristics of each premium payment option. Which of the following statements accurately describes the differences between level premium and flexible premium payment structures in universal life insurance? A. Level premium policies allow policyholders to adjust premium amounts over time, while flexible premium policies have fixed premium amounts. B. Level premium policies have fixed premium amounts for the policy's duration, while flexible premium policies allow policyholders to vary premium payments within certain limits. C. Level premium policies require upfront lump sum premium payments, while flexible premium policies allow installment payments over time. D. Level premium policies offer lower premiums compared to flexible premium policies, but provide less flexibility in premium payment amounts. The correct answer, B. Level premium policies have fixed premium amounts for the policy's duration, while flexible premium policies allow policyholders to vary premium payments within certain limits. Explanation. In universal life insurance, premium payment options can vary based on the policy structure chosen by the policyholder. Level premium policies require the policyholder to pay a fixed premium amount for the duration of the policy, typically until age 100 or until the policy matures. This predictable premium structure offers stability and consistency in premium payments. In contrast, flexible premium policies allow policyholders to adjust premium payments within certain limits, providing greater flexibility to accommodate changes in financial circumstances or cash flow. Policyholders can choose to pay higher premiums to accelerate cash value accumulation or reduce premiums during periods of financial strain. Understanding the differences between level and flexible premium payment structures enables policyholders to select the option that best aligns with their financial goals and preferences. Question 19. Mr. Anderson is a 45-year-old healthy male considering purchasing a life insurance policy. He wants a guaranteed death benefit and a cash value component that grows over time. Which type of life insurance policy best meets Mr. Anderson's needs? A. Term life insurance. B. Whole life insurance. C. Universal life insurance. D. Group life insurance. The correct answer, B. Whole life insurance. Explanation. Term life insurance only provides a death benefit if the insured dies within a specific period, term, and does not have a cash value component. Universal life insurance is another type of permanent life insurance but offers more flexibility in premiums and death benefit adjustments. Group life insurance is typically offered through employers and provides coverage for a group of people at a lower cost. It usually has no cash value component. Question 20. Ms. Lee has a whole life insurance policy with a current cash value of $20,000. She needs money for an unexpected car repair. The policy allows her to withdraw funds from the cash value. What are some potential consequences of Ms. Lee withdrawing cash from her whole life policy? A. There are no consequences. She can withdraw freely. B. The death benefit will decrease by the amount withdrawn. C. She will lose her guaranteed death benefit. D. She may have to pay taxes on the withdrawn amount. The correct answer, B. The death benefit will decrease by the amount withdrawn. Explanation. While Ms. Lee can withdraw funds from the cash value, it's not without consequences. The guaranteed death benefit remains as long as the policy remains active and premiums are paid. Withdrawing cash value may have tax implications depending on the amount withdrawn and the specific policy details. It's best to consult with a tax advisor for specific situations. Question 21. According to Indiana insurance regulations, what is the minimum disclosure requirement for whole life insurance policies regarding the cash value component? A. No disclosure is required. B. The policy must outline how the cash value grows but not the guaranteed interest rate. C. The policy must explain how to withdraw cash but not the tax implications. D. The policy must disclose the guaranteed interest rate and how the cash value accumulates. The correct answer, D. The policy must disclose the guaranteed interest rate and how the cash value accumulates. Explanation. This includes disclosing the guaranteed interest rate, if any, and how the cash value accumulates over time. The policy should also explain the options available for withdrawing cash and any associated fees or surrender charges. Tax implications of withdrawals are not required to be disclosed in the policy itself, but it's a good practice for insurance companies to recommend consulting with a tax advisor. Question 22. Mrs. Garcia is considering purchasing a whole life insurance policy for her newborn child. What are some advantages of purchasing a whole life policy at a young age? A. Premiums are typically higher for younger individuals. B. The cash value has more time to grow and accrue interest. C. The death benefit is locked in at a young age, regardless of future health conditions. D. Whole life insurance is not suitable for children. The correct answer, B. The cash value has more time to grow and accrue interest. Explanation. While premiums are generally lower for younger and healthier individuals compared to older applicants, there is still an advantage to starting a whole life policy young. The key benefit is that the cash value has a longer period to accumulate interest and grow over time. This can be a significant advantage in the long run. The death benefit is typically based on the initial coverage amount and may increase with some policies, but it's not guaranteed to cover future health conditions. Whole life insurance can be a valuable tool for long-term financial planning, even for children. Question 23. Mr. Hernandez has a whole life insurance policy with a loan provision. He's considering taking a loan against his cash value to help with a down payment on a house. What are some important factors for Mr. Hernandez to consider before taking a loan from his policy? A. The interest rate on the loan is typically lower than traditional loans. B. Outstanding loan amounts reduce the available cash value and death benefit. C. Taking a loan has no impact on the policy as long as it's repaid. D. There are no fees associated with policy loans. The correct answer, B. Outstanding loan amounts reduce the available cash value and death benefit. Explanation. While some whole life policies offer loan provisions, it's important to understand the implications before borrowing. The interest rate on the loan may be competitive, but it's typically higher than savings account interest rates. The outstanding loan amount is deducted from the cash value and death benefit. This means the policy will have less cash value available for withdrawals, and the death benefit will be reduced by the loan amount if the insured dies before repaying it. There may be fees associated with taking out a loan, such as loan origination fees or administrative charges. Question 24. According to Indiana insurance regulations, what are some acceptable uses for policy dividends in a participating whole life insurance policy? A. Dividends must be used to reduce the death benefit. B. The policyholder can choose to receive the dividend as cash. C. Dividends can only be used to pay premiums. D. Dividends have no value and cannot be used by the policyholder. The correct answer, B. The policyholder can choose to receive the dividend as cash. Explanation. Participating whole life insurance policies offer policyholders the potential to share in the company's profits through dividends. Dividends are not guaranteed but can be used in various ways depending on the policy and the policyholder's choice. Policyholders can elect to receive the dividend as cash, use it to pay premiums, purchase additional paid-up insurance, or accumulate at a higher interest rate within the policy. Dividends cannot be used to reduce the death benefit. That would defeat the purpose of the insurance. Question 25. What distinguishes a variable life insurance policy from a traditional whole life insurance policy? A. The premiums are fixed for the life of the policyholder. B. The policyholder can choose how the cash value is invested. C. The death benefit decreases over time. D. The policyholder can borrow against the cash value. The correct answer, B. The policyholder can choose how the cash value is invested. Explanation. Variable life insurance policies offer policyholders the ability to allocate their premiums among a variety of investment options, such as stocks, bonds, and money market funds. This means that the cash value of the policy is subject to market fluctuations and can potentially grow more quickly than with a traditional whole life policy, where the cash value typically earns a fixed rate of interest determined by the insurance company. However, it's important to note that with the potential for higher returns comes increased risk. Policyholders bear the investment risk, meaning that if the chosen investments perform poorly, the cash value and death benefit of the policy may decrease. This aspect of variable life insurance policies underscores the importance of understanding and carefully considering investment options and risks. Question 26. Ms. Rodriguez is considering purchasing a variable life insurance policy. What should she understand about the investment component of this policy? A. The cash value is guaranteed to increase annually. B. Policyholders have no say in how the cash value is invested. C. The policy's cash value is not affected by the performance of the underlying investments. D. The policy's death benefit may fluctuate based on the performance of the investments. The correct answer, D. The policy's death benefit may fluctuate based on the performance of the investments. Explanation. Variable life insurance policies offer a unique feature wherein the policyholder can allocate the cash value among various investment options. These investment options typically include mutual funds or similar investment vehicles. Unlike traditional life insurance policies where the death benefit remains constant, the death benefit of a variable life insurance policy may fluctuate based on the performance of the underlying investments. If the investments perform well, the death benefit may increase, providing higher payouts to beneficiaries. Conversely, if the investments perform poorly, the death benefit may decrease. This investment risk is borne by the policyholder, highlighting the importance of carefully assessing investment options and risk tolerance before selecting a variable life insurance policy. Question 27. Mr. Thompson is interested in purchasing a variable life insurance policy but is concerned about the investment risks involved. What feature of variable life insurance can help mitigate these risks? A. Guaranteed minimum death benefit. B. Fixed premium payments. C. Ability to switch investment options at any time. D. Partial withdrawal option without penalty. The correct answer: A. Guaranteed minimum death benefit. Explanation: variable life insurance policies offer policyholders the opportunity for potentially higher returns through investment in separate accounts. However, with the potential for higher returns comes increased investment risk. To address concerns about market volatility and investment risk, variable life insurance policies often come with a feature known as a guaranteed minimum death benefit. This feature ensures that, regardless of the performance of the underlying investments, the policyholder's beneficiaries will receive a minimum death benefit upon the insured's death. The guaranteed minimum death benefit provides peace of mind to policyholders by protecting against significant declines in the cash value due to poor investment performance. It's essential for individuals considering variable life insurance policies to understand the terms and conditions associated with the guaranteed minimum death benefit and how it impacts the overall cost and structure of the policy. Question 28. What is a key advantage of a variable life insurance policy over a traditional whole life insurance policy? A. Fixed premium payments. B. Guaranteed minimum cash value. C. Potential for higher investment returns. D. Guaranteed death benefit. The correct answer: C. Potential for higher investment returns. Explanation: one of the primary advantages of variable life insurance policies is the potential for higher investment returns compared to traditional whole life insurance policies. In variable life insurance, the cash value of the policy is invested in separate accounts, typically consisting of various investment options such as stocks, bonds, or mutual funds. The performance of these investments directly impacts the growth of the cash value. Unlike whole life policies, where the cash value grows at a fixed rate determined by the insurer, variable life policies allow policyholders to potentially benefit from market gains. While this potential for higher returns comes with increased investment risk, it also offers the opportunity for greater wealth accumulation over the long term, making variable life insurance attractive to individuals seeking both life insurance protection and investment growth. Question 29. What role does the Securities and Exchange Commission, SEC, play in regulating variable life insurance policies? A. Setting premium rates. B. Approving policy illustrations. C. Regulating the investment component. D. Determining policy surrender values. The correct answer: C. Regulating the investment component. Explanation: the Securities and Exchange Commission, SEC, plays a significant role in regulating the investment component of variable life insurance policies. Variable life insurance policies involve the investment of premiums into separate accounts, which typically consist of stocks, bonds, or mutual funds. Since these investments are subject to market risks, the SEC regulates the sale and distribution of variable life insurance policies under the federal securities laws. This oversight ensures that the investment options offered within variable life insurance policies comply with disclosure and reporting requirements to protect policyholders and investors. Additionally, insurance agents and brokers selling variable life insurance policies must be registered with the SEC and adhere to specific regulations governing the marketing and sale of securities products. By regulating the investment component, the SEC aims to maintain the integrity and transparency of variable life insurance products and safeguard the interests of consumers. Question 30. Mr. Davis has a variable life insurance policy with an accumulated cash value. He wants to access some of the funds for a home renovation project. What option does he have to access the cash value of his policy? A. Surrendering the policy. B. Taking out a policy loan. C. Withdrawing dividends. D. Converting the policy to a term life insurance policy. The correct answer: B. Taking out a policy loan. Explanation: policyholders of variable life insurance policies have several options for accessing the cash value accumulated within their policies. One common option is to take out a policy loan. Policy loans allow the policyholder to borrow against the cash value of the policy, using the policy itself as collateral. Unlike traditional bank loans, policy loans typically do not require a credit check or loan application process and may offer lower interest rates. Additionally, Policy loans do not trigger taxable events, meaning the borrowed funds are not subject to income tax. However, it's important to note that any outstanding policy loans will reduce the death benefit payable to beneficiaries and may accrue interest over time. Therefore, policyholders should carefully consider the implications of taking out a policy loan and ensure they have a plan for repaying the borrowed funds to maintain the intended life insurance coverage for their beneficiaries. Question 31. Ms. Jones is 45 years old and looking for a life insurance policy that offers both a death benefit and the potential for cash value growth. She is comfortable with some level of investment risk. Question. Which of the following features is typically not associated with a variable life insurance policy? A. Flexible premium payments. B. Death benefit that fluctuates based on investment performance. C. Guaranteed minimum death benefit. D. Tax-deferred growth of cash value. Correct answer. C. Guaranteed minimum death benefit. Explanation. Variable life insurance policies are a type of permanent life insurance that links the cash value and death benefit to the performance of underlying investments, typically sub-accounts similar to mutual funds. This means the cash value and death benefit can fluctuate up or down based on investment returns. Flexible premium payments. Variable life policies often allow for flexibility in premium payments, similar to universal life insurance. Death benefit that fluctuates. A key feature of variable life insurance is that the death benefit is not guaranteed to remain level and can increase or decrease based on investment performance. Tax-deferred growth. Cash value in a variable life policy grows on a tax-deferred basis, meaning taxes are not paid on earnings until money is withdrawn. Guaranteed minimum death benefits are typically associated with fixed universal life insurance, not variable universal life. In guaranteed universal life, the death benefit remains level or grows over time, regardless of investment performance. Question 32. Scenario. Mr. Lee is considering purchasing a variable life insurance policy. He plans to invest a large portion of his cash value in an aggressive sub-account in hopes of maximizing returns. The insurance agent mentions surrender charges that apply to withdrawals from the cash value in the early years of the policy. Question. Why might surrender charges be a concern for Mr. Lee in this scenario? A. Surrender charges reduce the death benefit amount. B. They can apply to both withdrawals and loans from the cash value. C. Surrender charges can significantly reduce the amount of money Mr. Lee receives if he needs to access his cash value early. D. Only investment losses trigger surrender charges. Correct answer. C. Surrender charges can significantly reduce the amount of money Mr. Lee receives if he needs to access his cash value early. Explanation. Surrender charges are fees imposed by the insurance company when a policyholder withdraws or takes a loan from the cash value of a variable life insurance policy, particularly in the early years. These charges are designed to discourage policyholders from withdrawing money too soon, which could negatively impact the long-term growth potential of the policy and the insurer's ability to pay future death benefits. Impact on death benefit. While surrender charges reduce the cash value available, they typically do not directly affect the death benefit amount stated in the policy, unless the withdrawal reduces the cash value below a minimum amount required to maintain the death benefit. Withdrawals and loans. Surrender charges can apply to both withdrawals and loans taken from the cash value. Investment losses. Surrender charges are separate from investment losses. Even if Mr. Lee's investments perform well, he could still face surrender charges if he withdraws money early. Question 33. Ms. Brown is reviewing the variable life insurance policy illustration provided by the insurance company. The illustration shows various figures, including the death benefit and cash value growth projections based on different investment returns. Question. According to the National Association of Insurance Commissioners, NAIC, Model Regulation on Disclosure for Variable Life Insurance and Variable Universal Life Insurance, what is not required to be included in the variable life insurance illustration? A. Guaranteed death benefit amount. B. Non-guaranteed cash value projections based on various investment scenarios. C. Sales charges associated with the policy. D. Federal income tax consequences of withdrawals from the cash value. Correct answer: A. Guaranteed death benefit amount. Explanation: the NAIC Model Regulation on Disclosure for Variable Life Insurance and Variable Universal Life Insurance outlines the information that must be included in the disclosure materials provided to potential variable life insurance policyholders. This ensures consumers have a clear understanding of the product features, benefits, and risks. Guaranteed death benefit. Variable life insurance policies typically do not have guaranteed death benefits. The death benefit amount fluctuates based on investment performance. The illustration will show the current death benefit but not a guaranteed amount. Question 34. What distinguishes final expense insurance policies from traditional life insurance policies? A. Final expense policies require a medical exam. B. Final expense policies have lower death benefits. C. Final expense policies have a fixed term. D. Final expense policies are specifically designed to cover funeral and burial expenses. The correct answer: D. Final expense policies are specifically designed to cover funeral and burial expenses. Explanation: final expense insurance policies, also known as burial insurance or funeral insurance, are specifically designed to cover the costs associated with a person's funeral, burial, and related expenses. Unlike traditional life insurance policies, which may offer higher death benefits and serve broader financial protection purposes, final expense policies typically provide smaller death benefits intended to cover the specific expenses incurred upon the insured's death. Final expense policies are often marketed to individuals who want to ensure that their loved ones are not burdened with the costs of their final arrangements. These policies may be more accessible for individuals who may not qualify for or need larger life insurance policies requiring medical exams or extensive underwriting. By providing a designated fund to cover funeral expenses, final expense insurance policies offer peace of mind to policyholders and their families during challenging times. Question 35. What is an advantage of purchasing a final expense insurance policy? A. Guaranteed cash value accumulation. B. Flexible premium payment options. C. Access to accelerated death benefits. D. Ease of qualification without medical exams. The correct answer: D. Ease of qualification without medical exams. Explanation: one of the primary advantages of purchasing a final expense insurance policy is the ease of qualification without the need for medical exams. Unlike many traditional life insurance policies that require applicants to undergo medical underwriting to assess their health status and determine eligibility, final expense policies often have simplified underwriting processes. This means that individuals with pre-existing health conditions or those who may not qualify for standard life insurance coverage due to age or health reasons can still obtain final expense insurance coverage. Simplified underwriting typically involves answering a few health-related questions, and coverage is often guaranteed regardless of the applicant's health status. By eliminating the need for medical exams and extensive underwriting, final expense insurance policies offer a convenient and accessible option for individuals seeking to provide financial protection for their end-of-life expenses. Question 36. Ms. Smith is considering purchasing a final expense insurance policy to ensure her funeral expenses are covered. What feature of these policies should she understand regarding premium payments? A. Premiums are adjustable based on investment performance. B. Premiums increase over time. C. Premiums remain fixed for the duration of the policy. D. Premiums are waived after a certain age. The correct answer: C. Premiums remain fixed for the duration of the policy. Explanation: final expense insurance policies typically feature fixed premiums, meaning that the premium amount remains consistent for the duration of the policy. Unlike some types of life insurance policies where premiums may fluctuate based on factors such as investment performance or changes in the insured's age or health status, final expense policies offer predictability and stability in premium payments. This fixed premium feature allows policyholders to budget for their insurance expenses without worrying about unexpected rate increases. Additionally, fixed premiums ensure that the policy remains affordable and sustainable over time, providing long-term financial security for the insured and their beneficiaries. It's essential for individuals considering final expense insurance to understand the terms and conditions associated with premium payments and how they impact the overall cost and coverage of the policy. Question 37. What is the primary purpose of accelerated death benefits in final expense insurance policies? A. To increase the policy's death benefit over time. B. To provide cash value accumulation options. C. To allow policyholders to access a portion of the death benefit while still alive. D. To offer premium payment flexibility. The correct answer, C. To allow policyholders to access a portion of the death benefit while still alive. Explanation. Accelerated death benefits, also known as living benefits, are a feature commonly found in final expense insurance policies. The primary purpose of accelerated death benefits is to allow policyholders to access a portion of the death benefit while still alive if they are diagnosed with a qualifying terminal illness or critical medical condition. This feature provides policyholders with financial assistance to cover medical expenses or other needs during a challenging time without having to wait until after their death for their beneficiaries to receive the full death benefit. By offering accelerated death benefits, final expense insurance policies provide additional flexibility and support to policyholders and their families when faced with serious health issues. Question 38. What happens to the death benefit of a final expense insurance policy if the insured passes away before the policy's maturity date? A. The death benefit is forfeited to the insurance company. B. The death benefit is paid to the insured's estate. C. The death benefit is adjusted based on the insured's age at death. D. The death benefit is paid to the designated beneficiaries tax-free. The correct answer, D. The death benefit is paid to the designated beneficiaries tax-free. Explanation. In the event of the insured's death before the maturity date of a final expense insurance policy, the death benefit is typically paid to the designated beneficiaries tax-free. Final expense insurance policies are designed to provide financial assistance to cover funeral and burial expenses and other related costs upon the insured's death. The death benefit amount, which is determined at the time of policy issuance, is paid out to the beneficiaries named by the insured. These beneficiaries can use the death benefit funds to cover funeral expenses, outstanding debts, or any other financial needs that may arise. Unlike some other forms of insurance proceeds, final expense insurance death benefits are typically not subject to income tax, providing beneficiaries with a tax-free source of funds to help alleviate financial burdens during a difficult time. Question 39. Mr. Thompson purchased a final expense insurance policy several years ago. He now wants to increase the coverage amount to account for rising funeral costs. What option does he have to adjust his coverage? A. Surrendering the existing policy and purchasing a new one with higher coverage. B. Paying additional premiums to increase the coverage amount. C. Converting the policy to a term life insurance policy. D. Requesting a loan against the policy's cash value to fund additional coverage. The correct answer, B. Paying additional premiums to increase the coverage amount. Explanation. Policyholders of final expense insurance policies typically have the option to adjust their coverage amount by paying additional premiums to increase the death benefit. Unlike some other insurance products where surrendering the existing policy and purchasing a new one may be the only option to adjust coverage, final expense policies often allow policyholders to increase coverage without having to go through the underwriting process again. By paying additional premiums, policyholders can secure higher death benefits to account for changes in their financial needs or to keep pace with rising funeral costs. This flexibility in coverage adjustment ensures that final expense insurance policies can adapt to the changing circumstances and preferences of policyholders over time. Question 40. What is the primary purpose of a final expense insurance policy rider? A. To increase the policy's cash value. B. To provide additional coverage for specific events. C. To allow for premium payment flexibility. D. To waive premium payments in the event of disability. The correct answer, B. To provide additional coverage for specific events. Explanation. A final expense insurance policy rider serves the primary purpose of providing additional coverage for specific events or circumstances not covered by the base policy. Riders can enhance the policy by offering additional benefits tailored to the policyholder's needs. Common final expense insurance riders include accidental death riders, which provide an additional death benefit if the insured's death results from an accident, and inflation protection riders, which adjust the death benefit over time to keep pace with rising funeral costs. By adding riders to their final expense insurance policies, policyholders can customize their coverage to address specific concerns and provide additional financial protection for themselves and their beneficiaries. Question 41. What is a key feature of graded death benefit final expense insurance policies? A. Premiums decrease over time. B. Cash value accumulation. C. Death benefit increases annually. D. Death benefit is limited during the first few years of the policy. The correct answer, D. Death benefit is limited during the first few years of the policy. Explanation. Graded death benefit final expense insurance policies are designed to provide coverage for individuals who may have difficulty qualifying for traditional life insurance due to health issues or other factors. One key feature of graded death benefit policies is that the death benefit is limited during the first few years of the policy. Instead of providing the full death benefit immediately upon the insured's death, graded death benefit policies typically have a waiting period, often ranging from 1 to 3 years. During this waiting period, if the insured passes away due to natural causes, the death benefit paid to the beneficiaries is limited to a percentage of the total death benefit, typically ranging from 25% to 100%. After the waiting period expires, the full death benefit becomes payable for death due to any cause. Graded death benefit policies offer a solution for individuals who may not qualify for immediate full coverage but still want to ensure their final expenses are covered over time. Question 42. What is the primary advantage of purchasing a final expense insurance policy through a funeral home? A. Lower premiums. B. Guaranteed acceptance regardless of health. C. Coverage tailored specifically for funeral expenses. D. Access to investment options for cash value growth. The correct answer, C. Coverage tailored specifically for funeral expenses. Explanation. One primary advantage of purchasing a final expense insurance policy through a funeral home is that the coverage is tailored specifically for funeral expenses. Funeral homes often offer pre-need funeral planning services, which allow individuals to pre-arrange and prepay for their funeral and burial expenses. As part of these services, funeral homes may offer final expense insurance policies designed to cover the anticipated costs of funeral arrangements, such as caskets, burial plots, and memorial services. These policies are structured to provide a designated amount of coverage specifically for funeral expenses, ensuring that the funds are available when needed to cover the costs associated with end-of-life arrangements. By purchasing a final expense insurance policy through a funeral home, individuals can streamline the funeral planning process and ensure that their final wishes are carried out without placing financial burdens on their loved ones. Question 43. What is the significance of the face amount in a final expense insurance policy? A. It represents the cash value of the policy. B. It determines the premium payment schedule. C. It specifies the total amount payable upon the insured's death. D. It indicates the policy's surrender value. The correct answer, C. It specifies the total amount payable upon the insured's death. Explanation. The face amount of a final expense insurance policy specifies the total amount payable to the designated beneficiaries upon the insured's death. This amount is also known as the death benefit and is intended to cover the expenses associated with the insured's funeral, burial, and related costs. Unlike the cash value or surrender value of the policy, which may fluctuate based on factors such as premium payments and investment performance, the face amount remains constant and is guaranteed to be paid out to the beneficiaries upon the insured's death. Policyholders can select the face amount of their final expense insurance policy based on their anticipated funeral expenses and the level of financial support they wish to provide to their beneficiaries. By determining the face amount, policyholders ensure that their loved ones have the necessary funds to cover end-of-life expenses and alleviate financial burdens during a difficult time. Question 44. Which of the following statements best describes an accidental death benefit (ADB) rider in a life insurance policy? A. ADB rider provides coverage only if the insured dies in an accident while traveling abroad. B. ADB rider provides an additional benefit if the insured dies due to an accident, on top of the base life insurance coverage. C. ADB rider covers only specific types of accidents listed in the policy. D. ADB rider increases the cash value of the policy over time. The correct answer, B. ADB rider provides an additional benefit if the insured dies due to an accident, on top of the base life insurance coverage. Explanation. An accidental death benefit (ADB) rider is an optional addition to a life insurance policy that provides an additional benefit if the insured dies due to an accident. This benefit is paid in addition to the base life insurance coverage amount. It is important to note that the definition of accident may vary between insurance policies, but typically includes events such as car accidents, falls, drowning, or other sudden and unforeseen events resulting in death. This rider is valuable because it offers extra financial protection to the insured's beneficiaries in the event of an accidental death. It's crucial for policyholders to review the terms and conditions of the ADB rider carefully to understand the specific coverage provided. Additionally, it's essential to differentiate between ADB coverage and other types of insurance, such as travel insurance, which may have different coverage criteria and limitations. Question 45. Mr. Smith has a life insurance policy with an accidental death benefit (ADB) rider. Unfortunately, he passed away due to a heart attack. Which of the following statements regarding the ADB rider in this situation is correct? A. The ADB rider will provide additional benefits because the insured died suddenly. B. The ADB rider will not provide any benefits because the insured's death was not accidental. C. The ADB rider will only provide benefits if the insured died in a car accident. D. The ADB rider will provide benefits equivalent to the base life insurance coverage. The correct answer, B. The ADB rider will not provide any benefits because the insured's death was not accidental. Explanation. In this scenario, Mr. Smith's death was due to a heart attack, which is not considered an accidental death. Accidental death benefit (ADB) riders are specifically designed to provide additional benefits in the event of the insured's death resulting from an accident. Since Mr. Smith's death was not accidental, the ADB rider would not provide any additional benefits beyond the base life insurance coverage. It's crucial for policyholders to understand that ADB riders do not cover all causes of death but rather only those that result from qualifying accidents as defined by the insurance policy. Heart attacks, strokes, illnesses, or natural causes are typically excluded from ADB coverage. Policyholders should review their insurance policies carefully and consult with their insurance agents to understand the coverage limitations and exclusions associated with ADB riders. Question 46. Which of the following is not a typical feature of an accidental death benefit (ADB) rider? A. Coverage for death resulting from accidents such as car crashes and falls. B. Additional benefit paid on top of the base life insurance coverage in case of accidental death. C. Requirement for the insured to be actively employed at the time of the accident. D. Exclusions for death caused by illegal activities or self-inflicted injuries. The correct answer, C. Requirement for the insured to be actively employed at the time of the accident. Explanation. An accidental death benefit (ADB) rider typically provides additional benefits if the insured dies as a result of an accident, on top of the base life insurance coverage. This additional benefit is paid to the beneficiaries of the policy. The rider covers various types of accidents, such as car crashes, falls, drowning, or other unforeseen events resulting in death. While ADB riders may have certain exclusions, such as death caused by illegal activities or self-inflicted injuries, they do not typically require the insured to be actively employed at the time of the accident. The purpose of the ADB rider is to provide additional financial protection to the insured's beneficiaries in the event of an accidental death, regardless of the insured's employment status at the time of the accident. It's essential for policyholders to review the terms and conditions of the ADB rider carefully to understand the coverage provided and any exclusions that may apply. Additionally, consulting with an insurance agent can help clarify any questions or concerns regarding ADB coverage. Question 47. Which of the following statements regarding the accidental death benefit ADB rider is true? A. The ADB rider provides coverage for all types of accidents, including those occurring during extreme sports activities. B. ADB rider benefits are typically equal to the face value of the base life insurance policy. C. ADB rider premiums are usually higher than those for the base life insurance policy. D. The ADB rider can be added to a health insurance policy to provide coverage for accidental injuries. The correct answer, C. ADB rider premiums are usually higher than those for the base life insurance policy. Explanation. ADB riders typically come with additional premiums, as they provide an extra benefit in the event of an accidental death on top of the base life insurance coverage. The premiums for ADB riders are higher because they increase the overall level of coverage provided by the policy. Insurance companies assess the increased risk associated with accidental deaths and adjust premiums accordingly. It's important for policyholders to carefully consider the cost of adding an ADB rider to their life insurance policy and evaluate whether the additional benefits justify the higher premiums. While ADB riders can offer valuable financial protection in the event of an accidental death, individuals should assess their own risk factors and financial needs before making a decision. Question 48. Ms. Martinez has a life insurance policy with an accidental death benefit ADB rider. She passes away due to injuries sustained in a car accident. Which of the following statements regarding the ADB rider in this situation is correct? A. The ADB rider will not provide any benefits because the insured's death was not sudden. B. The ADB rider will provide benefits equivalent to the base life insurance coverage. C. The ADB rider will provide additional benefits on top of the base life insurance coverage. D. The ADB rider will only provide benefits if the insured died in a workplace accident. The correct answer, C. The ADB rider will provide additional benefits on top of the base life insurance coverage. Explanation. In this scenario, Ms. Martinez's death resulted from injuries sustained in a car accident, which is typically considered an accidental death covered by the ADB rider. Therefore, the ADB rider will provide additional benefits on top of the base life insurance coverage amount. ADB riders are designed to offer extra financial protection to the insured's beneficiaries in the event of an accidental death. The additional benefits provided by the ADB rider can help alleviate financial burdens associated with unexpected accidents, such as medical expenses, funeral costs, or loss of income. It's essential for policyholders to understand the specific coverage provided by the ADB rider and any limitations or exclusions that may apply. Reviewing the terms and conditions of the rider and consulting with an insurance agent can help ensure that individuals have a clear understanding of their insurance coverage. Question 49. Which of the following is typically not covered by an accidental death benefit ADB rider? A. Death resulting from a fall at home. B. Death due to a heart attack. C. Death caused by drowning. D. Death resulting from a car accident. The correct answer, B. Death due to a heart attack. Explanation. Accidental death benefit ADB riders are designed to provide additional benefits in the event of the insured's death due to an accident. Typically covered accidents include falls, drowning, car accidents, and other unforeseen events. However, death due to natural causes, such as a heart attack or illness, is typically not covered by an ADB rider. It's essential for policyholders to understand the limitations and exclusions of ADB riders when evaluating their insurance coverage. While ADB riders can offer valuable financial protection in the event of an accidental death, they do not provide coverage for deaths resulting from natural causes or pre-existing medical conditions. Reviewing the terms and conditions of the rider and consulting with an insurance agent can help individuals understand the specific coverage provided by their policy. Question 50. Which of the following best describes the purpose of an accidental death benefit (ADB) rider in a life insurance policy? A. To provide coverage for accidental injuries and medical expenses. B. To offer additional benefits in the event of the insured's death due to an accident. C. To increase the cash value of the policy over time. D. To provide coverage for death resulting from natural causes. The correct answer, B. To offer additional benefits in the event of the insured's death due to an accident. Explanation. The primary purpose of an accidental death benefit (ADB) rider in a life insurance policy is to provide additional benefits if the insured dies as a result of an accident. This extra benefit is paid in addition to the base life insurance coverage and is intended to offer financial protection to the insured's beneficiaries in the event of an accidental death. ADB riders do not typically provide coverage for accidental injuries or medical expenses incurred by the insured while alive. Instead, they focus on providing a lump sum benefit to the beneficiaries if the insured dies due to a qualifying accident as defined by the insurance policy. Policyholders should carefully review the terms and conditions of their ADB rider to understand the specific coverage provided and any limitations or exclusions that may apply. Question 51. Mr. Thompson has a life insurance policy with an accidental death benefit (ADB) rider. He passes away due to injuries sustained in a skiing accident. Which of the following statements regarding the ADB rider in this situation is correct? A. The ADB rider will provide benefits only if the insured died while engaged in a hazardous activity. B. The ADB rider will not provide any benefits because skiing is considered a high-risk activity. C. The ADB rider will provide additional benefits on top of the base life insurance coverage. D. The ADB rider will provide benefits equivalent to the face value of the base life insurance policy. The correct answer, C. The ADB rider will provide additional benefits on top of the base life insurance coverage. Explanation. In this scenario, Mr. Thompson's death resulted from injuries sustained in a skiing accident, which typically qualifies as an accidental death covered by the ADB rider. Therefore, the ADB rider will provide additional benefits on top of the base life insurance coverage amount. ADB riders are designed to offer extra financial protection to the insured's beneficiaries in the event of an accidental death, regardless of the specific activity involved. While engaging in hazardous activities may increase the risk of accidents, ADB riders generally do not exclude coverage based on the nature of the activity. Policyholders should review the terms and conditions of their ADB rider to understand the specific coverage provided and any limitations or exclusions that may apply. Consulting with an insurance agent can also help clarify any questions or concerns regarding ADB coverage. Question 52. Which of the following scenarios illustrates an ethical issue in insurance marketing and advertising? A. An insurance agent exaggerates the benefits of a policy to persuade a client to purchase it. B. An insurance company offers discounted premiums to customers who provide false information on their applications. C. An insurance agency targets vulnerable populations with deceptive advertising to sell unnecessary coverage. D. An insurance broker discloses all relevant information to clients, ensuring they make informed decisions. The correct answer, C. An insurance agency targets vulnerable populations with deceptive advertising to sell unnecessary coverage. Explanation. Ethical issues in insurance marketing and advertising can arise when companies engage in deceptive practices to manipulate or take advantage of consumers. Targeting vulnerable populations with misleading or deceptive advertising to sell unnecessary coverage is an example of unethical behavior in the insurance industry. Such practices can harm consumers by misleading them into purchasing products they don't need or cannot afford. Insurance agents and companies have a responsibility to act with honesty, integrity, and transparency in their marketing and advertising efforts. Failure to do so not only violates ethical standards but may also result in legal and regulatory consequences. Question 53. Mr. Davis, an insurance agent, receives a commission for every policy he sells. He convinces a client to switch to a new policy, even though the client's existing policy meets their needs, solely to earn a higher commission. Which ethical principle is Mr. Davis violating? A. Integrity. B. Honesty. C. Disclosure. D. Fiduciary duty. The correct answer, D. Fiduciary duty. Explanation. Insurance agents owe their clients a fiduciary duty, which means they are legally and ethically obligated to act in the best interests of their clients. By persuading a client to switch policies solely to earn a higher commission, Mr. Davis is prioritizing his own financial interests over the client's needs, thereby violating his fiduciary duty. Maintaining trust and confidence is essential in the insurance industry, and agents must always prioritize the interests of their clients above their own financial gain. Violating fiduciary duty can result in reputational damage, regulatory sanctions, and legal consequences for the agent and the insurance company. Question 54. Which of the following practices is not considered an ethical issue in insurance marketing and advertising? A. Providing clear and accurate information about policy features and pricing. B. Using fear tactics to pressure consumers into purchasing insurance coverage. C. Offering incentives or rewards to clients for referrals. D. Making false or misleading statements about competitors' products. The correct answer, A. Providing clear and accurate information about policy features and pricing. Explanation. Providing clear and accurate information about policy features and pricing is an ethical practice in insurance marketing and advertising. Transparency and honesty are essential for building trust and credibility with consumers. However, using fear tactics to pressure consumers into purchasing insurance coverage, making false or misleading statements about competitors' products, and prioritizing financial incentives over client needs are all examples of unethical behavior in the insurance industry. Agents and insurance companies should strive to maintain high ethical standards in their marketing and advertising practices to protect consumers' interests and uphold the reputation of the industry. Regulatory bodies may impose penalties or sanctions on those found engaging in unethical behavior. Question 55. Which of the following statements best describes the concept of churning in insurance? A. Churning refers to the process of increasing policyholders' coverage without their consent. B. Churning occurs when insurance agents pressure clients into purchasing unnecessary policies to generate commissions. C. Churning involves providing false information on insurance applications to obtain lower premiums. D. Churning is a practice where insurance companies refuse to renew policies for high-risk individuals. The correct answer, B. Churning occurs when insurance agents pressure clients into purchasing unnecessary policies to generate commissions. Explanation. Churning in insurance refers to the unethical practice of agents persuading clients to purchase unnecessary policies or to replace existing policies solely to generate commissions. This often involves pressuring clients into making changes that are not in their best interests, such as increasing coverage unnecessarily or replacing a policy with a new one that offers little or no additional benefits. Churning can harm consumers by increasing their insurance costs, reducing the cash value of their policies, or exposing them to financial risks. It violates the agent's fiduciary duty to act in the best interests of the client and can result in legal and regulatory consequences. Question 56. Ms. Garcia, an insurance agent, exaggerates the benefits of a policy to convince a client to purchase it. Which ethical principle is Ms. Garcia violating? A. Integrity. B. Honesty. C. Transparency. D. Competence. The correct answer, B. Honesty. Explanation. By exaggerating the benefits of a policy, Ms. Garcia is failing to be honest with her client. Honesty is a fundamental ethical principle in insurance marketing and advertising. Agents have a duty to provide accurate and truthful information to clients, enabling them to make informed decisions about insurance coverage. Misrepresenting policy features or benefits can lead to misunderstandings, dissatisfaction, and financial harm for clients. Insurance agents must maintain integrity and honesty in their interactions with clients to uphold trust and credibility in the industry. Question 57. Which of the following is not an example of an ethical issue in insurance marketing and advertising? A. Offering incentives to clients for providing referrals. B. Making false statements about competitors' products to discredit them. C. Engaging in discriminatory practices when targeting certain demographic groups. D. Providing clear and accurate information about policy exclusions and limitations. The correct answer, D. Providing clear and accurate information about policy exclusions and limitations. Explanation. Providing clear and accurate information about policy exclusions and limitations is not an ethical issue but rather a fundamental ethical practice in insurance marketing and advertising. Transparency is essential for ensuring that clients understand the terms and conditions of their policies and can make informed decisions about their coverage. In contrast, offering incentives for referrals, making false statements about competitors' products, and engaging in discriminatory practices are all examples of unethical behavior in insurance marketing and advertising. These practices can harm consumers, undermine trust in the industry, and may lead to legal and regulatory consequences. Question 58. Mr. Thompson, an insurance agent, convinces a client to cancel their existing policy and switch to a new one, even though the new policy offers fewer benefits, solely to earn a higher commission. Which ethical principle is Mr. Thompson violating? A. Fiduciary duty. B. Disclosure. C. Competence. D. Integrity. The correct answer, A. Fiduciary duty. Explanation. By prioritizing his own financial interests over the client's needs, Mr. Thompson is violating his fiduciary duty as an insurance agent. Fiduciary duty requires agents to act in the best interests of their clients, placing the client's needs ahead of their own financial gain. Encouraging a client to cancel an existing policy and switch to a new one that offers fewer benefits solely to earn a higher commission is unethical and can harm the client financially. Agents must always prioritize the interests of their clients and provide recommendations that are in the client's best interests. Question 59. Which of the following practices is considered an ethical issue in insurance marketing and advertising? A. Providing accurate information about policy premiums and coverage options. B. Using persuasive language to encourage clients to consider purchasing additional coverage. C. Disclosing potential conflicts of interest to clients when recommending specific policies. D. Making false promises or guarantees about the benefits of a policy to attract customers. The correct answer, D. Making false promises or guarantees about the benefits of a policy to attract customers. Explanation. Making false promises or guarantees about the benefits of a policy to attract customers is considered an ethical issue in insurance marketing and advertising. This practice can mislead consumers into purchasing coverage based on inaccurate or exaggerated claims, leading to dissatisfaction and financial harm. Honesty and integrity are fundamental principles in insurance marketing and advertising. Agents and insurance companies have a responsibility to provide clear, accurate, and truthful information to consumers about policy features, benefits, and limitations to ensure that they can make informed decisions about their coverage. Question 60. An insurance company runs an advertising campaign targeting senior citizens, promising guaranteed returns on investment in its insurance policies. However, the fine print reveals that the guaranteed returns are subject to certain conditions and may not be as high as advertised. Which ethical principle is being violated in this scenario? A. Honesty. B. Competence. C. Fiduciary duty. D. Transparency. The correct answer, D. Transparency. Explanation. The insurance company's failure to provide transparent and accurate information about the guaranteed returns on investment violates the ethical principle of transparency. Transparency requires insurance companies to disclose all relevant information about policy features, benefits, limitations, and conditions in a clear and accessible manner. Failing to do so can mislead consumers and erode trust in the industry. Question 61. Which of the following actions by an insurance agent would be considered unethical in marketing and advertising? A. Providing clients with accurate information about available policy options. B. Offering incentives to clients for referring new customers to the agency. C. Misrepresenting policy benefits to make them appear more attractive. D. Disclosing potential conflicts of interest when recommending policies. The correct answer: C. Misrepresenting policy benefits to make them appear more attractive. Explanation: misrepresenting policy benefits to make them appear more attractive is unethical in insurance marketing and advertising. It involves providing false or misleading information to clients, which can lead to misunderstandings, dissatisfaction, and financial harm. Agents and insurance companies have a duty to provide clear, accurate, and truthful information about policy features, benefits, and limitations to ensure that clients can make informed decisions about their coverage. Question 62. Which of the following practices is an example of an ethical issue in insurance marketing and advertising? A. Providing clients with comparative analyses of different policy options to help them make informed decisions. B. Offering discounts to clients who maintain a safe driving record. C. Using fear tactics to pressure clients into purchasing insurance coverage. D. Disclosing potential conflicts of interest when recommending policies. The correct answer: C. Using fear tactics to pressure clients into purchasing insurance coverage. Explanation: using fear tactics to pressure clients into purchasing insurance coverage is unethical in insurance marketing and advertising. Fear-based marketing strategies can manipulate consumers' emotions and coerce them into making decisions they may later regret. Ethical marketing practices in insurance emphasize providing clients with clear, accurate, and relevant information to help them assess their needs and make informed decisions about their coverage. Fear tactics undermine trust and integrity in the industry and can lead to consumer harm. Question 63. Which of the following actions by an insurance agent would be considered a violation of professional codes of conduct? A. Providing clients with accurate information about policy features and coverage options. B. Disclosing potential conflicts of interest when recommending insurance products. C. Charging clients higher premiums based on their age or gender. D. Failing to maintain confidentiality of clients' personal information. The correct answer: C. Charging clients higher premiums based on their age or gender. Explanation: charging clients higher premiums based on their age or gender is considered discriminatory and violates professional codes of conduct for insurance agents and brokers. The principle of fairness dictates that insurance premiums should be based on risk factors related to the insured's behavior, health, and lifestyle, rather than personal characteristics such as age or gender. Insurance agents and brokers are required to adhere to strict ethical standards that prohibit discriminatory practices and ensure fair treatment of all clients. Violating professional codes of conduct can lead to legal and regulatory consequences, as well as reputational damage for the agent or brokerage firm. Question 64. Mr. Williams, an insurance agent, recommends a policy with higher premiums and fewer benefits to a client, even though a more suitable and affordable option is available. Which professional code of conduct is Mr. Williams violating? A. Integrity. B. Confidentiality. C. Competence. D. Fiduciary duty. The correct answer: D. Fiduciary duty. Explanation: by recommending a policy with higher premiums and fewer benefits when a more suitable and affordable option is available, Mr. Williams is violating his fiduciary duty as an insurance agent. Fiduciary duty requires agents to act in the best interests of their clients, prioritizing the client's needs over their own financial interests or those of the insurance company. Insurance agents are entrusted with the responsibility of providing clients with suitable and appropriate coverage that meets their needs and financial circumstances. Failing to fulfill this duty can harm clients financially and erode trust in the insurance industry. Question 65. Which of the following is not a key principle of professional codes of conduct for insurance agents and brokers? A. Transparency. B. Integrity. C. Loyalty to the insurance company. D. Confidentiality. The correct answer: C. Loyalty to the insurance company. Explanation: loyalty to the insurance company is not a key principle of professional codes of conduct for insurance agents and brokers. While agents have a contractual relationship with insurance companies to sell their products, their primary duty is to act in the best interests of their clients. Transparency, integrity, and confidentiality are fundamental principles that guide the conduct of insurance agents and brokers. Transparency requires agents to provide clear and accurate information to clients about policy features, benefits, and costs. Integrity dictates that agents must act honestly and ethically in all their interactions with clients and other stakeholders. Confidentiality obligates agents to protect the privacy and confidentiality of clients' personal information. Agents who prioritize loyalty to the insurance company over the interests of their clients risk violating ethical standards and damaging trust in the profession. Question 66. Which of the following scenarios illustrates a breach of professional codes of conduct for insurance agents and brokers? A. An agent recommends a policy to a client based on the client's specific needs and financial situation. B. An agent discloses confidential client information to a third party without the client's consent. C. An agent charges clients lower premiums based on their good health and lifestyle habits. D. An agent provides clients with clear and accurate information about policy exclusions and limitations. The correct answer: B. An agent discloses confidential client information to a third party without the client's consent. Explanation: disclosing confidential client information to a third party without the client's consent is a breach of professional codes of conduct for insurance agents and brokers. Agents are obligated to protect the privacy and confidentiality of client information and may only disclose such information with the client's explicit consent or as required by law. Maintaining confidentiality is essential for building trust and confidence in the agent-client relationship. Breaching confidentiality can result in serious consequences, including legal and regulatory sanctions, reputational damage, and loss of trust from clients. Question 67. Ms. Rodriguez, an insurance agent, convinces a client to purchase a policy with features and benefits that the client does not need or understand. Which professional principle is Ms. Rodriguez violating? A. Competence. B. Transparency. C. Integrity. D. Loyalty to the insurance company. The correct answer: A. Competence. Explanation: by convincing a client to purchase a policy with features and benefits that the client does not need or understand, Ms. Rodriguez is violating the professional principle of competence. Competence requires agents to have the knowledge, skills, and expertise necessary to provide clients with suitable and appropriate insurance solutions based on their individual needs and circumstances. Agents have a duty to assess clients' needs, explain policy features and options clearly, and recommend coverage that aligns with the client's goals and preferences. Failing to do so can harm clients financially and erode trust in the agent's competence and integrity. Question 68. Which of the following is not a fundamental principle of professional codes of conduct for insurance agents and brokers? A. Confidentiality. B. Disclosure of conflicts of interest. C. Advocacy for insurance companies. D. Fair treatment of clients. The correct answer: C. Advocacy for insurance companies. Explanation: advocacy for insurance companies is not a fundamental principle of professional codes of conduct for insurance agents and brokers. While agents may have contractual relationships with insurance companies to sell their products, their primary duty is to act in the best interests of their clients. Confidentiality, disclosure of conflicts of interest, and fair treatment of clients are key principles that guide the conduct of insurance agents and brokers. Agents are obligated to protect the privacy and confidentiality of client information, disclose any conflicts of interest that may affect their recommendations, and treat clients fairly and honestly in all interactions. Agents who prioritize advocacy for insurance companies over the interests of their clients risk violating ethical standards and undermining trust in the profession. Question 69. Mr. Nguyen, an insurance agent, recommends a policy to a client without disclosing that he will receive a higher commission for selling that particular policy. Which professional principle is Mr. Nguyen violating? A. Competence. B. Transparency. C. Integrity. D. Fiduciary duty. The correct answer, B. Transparency. Explanation. By recommending a policy without disclosing the potential conflict of interest regarding the higher commission, Mr. Nguyen is violating the professional principle of transparency. Transparency requires agents to disclose any conflicts of interest that may affect their recommendations, allowing clients to make informed decisions about their insurance coverage. Failing to disclose potential conflicts of interest can erode trust in the agent-client relationship and may result in legal and regulatory consequences. Agents must prioritize transparency in their interactions with clients to ensure fair and ethical practices. Question 70. Which of the following is not a responsibility of insurance agents and brokers under professional codes of conduct? A. Act in the best interests of clients. B. Disclose potential conflicts of interest to clients. C. Advocate for insurance companies. D. Provide clear and accurate information to clients. The correct answer, C. Advocate for insurance companies. Explanation. Advocating for insurance companies is not a responsibility of insurance agents and brokers under professional codes of conduct. While agents may represent insurance companies and sell their products, their primary duty is to act in the best interests of their clients. Agents are obligated to provide clients with clear, accurate, and unbiased information about insurance products and options, disclose any conflicts of interest that may affect their recommendations, and ensure that clients receive suitable and appropriate coverage based on their individual needs and circumstances. Advocating for clients' interests is paramount, and agents should prioritize transparency, integrity, and fairness in their interactions. Question 71. Which of the following actions by an insurance agent would be considered unethical according to professional codes of conduct? A. Providing clients with comprehensive information about policy options to help them make informed decisions. B. Offering incentives to clients for purchasing additional coverage beyond their needs. C. Failing to disclose potential conflicts of interest when recommending insurance products. D. Advising clients to regularly review and update their insurance coverage based on changing circumstances. The correct answer, B. Offering incentives to clients for purchasing additional coverage beyond their needs. Explanation. Offering incentives to clients for purchasing additional coverage beyond their needs is considered unethical according to professional codes of conduct for insurance agents and brokers. Agents have a duty to act in the best interests of their clients and provide recommendations that are suitable and appropriate based on the client's needs and circumstances. Encouraging clients to purchase unnecessary coverage in exchange for incentives can lead to financial harm for the clients and erode trust in the agent-client relationship. Agents should prioritize transparency, honesty, and integrity in their interactions with clients, ensuring that clients receive advice that is tailored to their individual needs. Question 72. Ms. Smith, an insurance agent, provides inaccurate information about policy benefits to a client in order to close a sale. Which professional principle is Ms. Smith violating? A. Competence. B. Confidentiality. C. Transparency. D. Fiduciary duty. The correct answer, C. Transparency. Explanation. By providing inaccurate information about policy benefits, Ms. Smith is violating the professional principle of transparency. Transparency requires agents to provide clear, accurate, and truthful information to clients about policy features, benefits, limitations, and costs. Misrepresenting policy benefits can mislead clients and result in financial harm, eroding trust in the agent and the insurance industry as a whole. Agents must prioritize transparency in their interactions with clients, ensuring that clients have the information they need to make informed decisions about their insurance coverage. Question 73. Which of the following is a fundamental principle of professional codes of conduct for insurance agents and brokers? A. Loyalty to insurance companies. B. Advocacy for industry regulations. C. Fair treatment of clients. D. Promotion of competitive practices. The correct answer, C. Fair treatment of clients. Explanation. Fair treatment of clients is a fundamental principle of professional codes of conduct for insurance agents and brokers. Agents have a duty to act in the best interests of their clients and provide recommendations that are fair, honest, and suitable based on the client's needs and circumstances. This principle requires agents to prioritize the interests of their clients above all else, ensuring that clients receive unbiased advice and appropriate coverage. Agents should act with integrity, transparency, and professionalism in their interactions with clients, fostering trust and confidence in the insurance industry. Question 74. Which of the following actions by an insurance agent violates professional codes of conduct? A. Providing clients with options from multiple insurance companies to compare and choose from. B. Offering discounts to clients who purchase policies through the agent's referral program. C. Failing to disclose the full extent of policy exclusions and limitations to clients. D. Assisting clients in submitting accurate and truthful information on insurance applications. The correct answer, C. Failing to disclose the full extent of policy exclusions and limitations to clients. Explanation. Failing to disclose the full extent of policy exclusions and limitations to clients violates professional codes of conduct for insurance agents and brokers. Agents are required to provide clients with clear, accurate, and complete information about policy features, benefits, exclusions, and limitations to ensure they can make informed decisions about their coverage. Failure to disclose such important information can lead to misunderstandings, dissatisfaction, and financial harm for clients. Agents should prioritize transparency and honesty in their interactions with clients, ensuring that clients understand the terms and conditions of their insurance policies. Question 75. Mr. Johnson, an insurance agent, convinces a client to cancel their existing policy and switch to a new one, even though the new policy offers fewer benefits and higher premiums. Which professional principle is Mr. Johnson violating? A. Competence. B. Transparency. C. Fiduciary duty. D. Confidentiality. The correct answer, C. Fiduciary duty. Explanation. By convincing a client to switch to a new policy with fewer benefits and higher premiums, Mr. Johnson is violating his fiduciary duty as an insurance agent. Fiduciary duty requires agents to act in the best interests of their clients, prioritizing the client's needs over their own financial interests or those of the insurance company. Encouraging a client to cancel an existing policy and switch to a new one that offers fewer benefits and higher premiums can harm the client financially and erode trust in the agent-client relationship. Agents must always prioritize the interests of their clients and provide recommendations that are in the client's best interests. Question 76. In the context of ethical considerations in underwriting and claims handling, which of the following actions by an insurance company would be considered unethical? A. Conducting thorough investigations to verify the validity of claims. B. Denying claims based on legitimate policy exclusions. C. Delaying claims processing without valid reasons. D. Providing policyholders with clear and transparent information about coverage limitations. The correct answer, C. Delaying claims processing without valid reasons. Explanation. Delaying claims processing without valid reasons is considered unethical in underwriting and claims handling. Insurance companies have a duty to promptly and fairly process claims submitted by policyholders. Unreasonable delays can cause financial hardship and emotional distress to policyholders who rely on insurance benefits to recover from losses. Ethical underwriting and claims handling practices prioritize prompt and efficient claims processing while ensuring that claims are assessed fairly and accurately. Insurance companies should communicate openly and transparently with policyholders about the status of their claims and provide clear explanations for any delays. Question 77. Ms. Adams, an underwriter at an insurance company, approves an applicant's policy application despite knowing that the applicant provided false information. Which ethical principle is Ms. Adams violating? A. Integrity. B. Confidentiality. C. Fairness. D. Competence. The correct answer, A. Integrity. Explanation. By approving an applicant's policy application despite knowing that the applicant provided false information, Ms. Adams is violating the ethical principle of integrity. Integrity requires underwriters and claims handlers to act honestly and ethically in all their dealings, maintaining high standards of professional conduct and upholding the trust and confidence of policyholders and other stakeholders. Approving a policy based on false information can lead to adverse consequences for the insurance company, including financial losses and reputational damage. Underwriters must adhere to strict ethical standards and exercise diligence in verifying the accuracy and truthfulness of information provided by applicants. Question 78. Which of the following is not a key consideration in ethical underwriting practices? A. Consistency in applying underwriting guidelines. B. Assessing applicants based on non-discriminatory criteria. C. Maximizing profits by minimizing claims payouts. D. Evaluating risk factors relevant to the insurance policy. The correct answer, C. Maximizing profits by minimizing claims payouts. Explanation. Maximizing profits by minimizing claims payouts is not a key consideration in ethical underwriting practices. While insurance companies aim to manage risk effectively and maintain financial stability, ethical underwriting practices prioritize fairness, transparency, and integrity in assessing applicants' risks and determining policy premiums. Ethical underwriters focus on evaluating risk factors relevant to the insurance policy and assessing applicants based on non-discriminatory criteria. Consistency in applying underwriting guidelines ensures fairness and equality in the underwriting process, while also upholding the trust and confidence of policyholders and the public in the insurance industry. Question 79. Which of the following actions by an insurance company would be considered ethical in claims handling? A. Denying a claim without thoroughly investigating its validity. B. Offering fair settlements to policyholders based on policy terms and coverage. C. Delaying claims processing indefinitely without providing updates to policyholders. D. Failing to communicate claim denials and reasons to policyholders. The correct answer, B. Offering fair settlements to policyholders based on policy terms and coverage. Explanation. Offering fair settlements to policyholders based on policy terms and coverage is considered ethical in claims handling. Ethical claims handling practices prioritize prompt and fair resolution of claims, ensuring that policyholders receive the benefits they are entitled to under their insurance policies. Denying claims without thorough investigation, delaying claims processing without valid reasons, or failing to communicate claim denials and reasons to policyholders are all unethical practices that can lead to distrust and dissatisfaction among policyholders. Insurance companies have a duty to act in good faith and treat policyholders fairly and respectfully throughout the claims process. Question 80. Mr. Brown, an insurance claims adjuster, provides preferential treatment to certain policyholders based on personal relationships, resulting in unfair outcomes for other policyholders. Which ethical principle is Mr. Brown violating? A. Integrity. B. Fairness. C. Confidentiality. D. Competence. The correct answer, B. Fairness. Explanation. By providing preferential treatment to certain policyholders based on personal relationships, Mr. Brown is violating the ethical principle of fairness. Fairness requires claims adjusters to treat all policyholders impartially and without bias, ensuring that each policyholder receives fair and equitable treatment in the claims handling process. Favoritism or preferential treatment can undermine the integrity of the claims handling process and erode trust in the insurance company. Claims adjusters must adhere to strict ethical standards and prioritize fairness and impartiality in their interactions with policyholders to maintain the credibility and reputation of the insurance industry. Question 81. Which of the following is a key consideration in ethical underwriting practices? A. Maximizing profitability by minimizing coverage for policyholders. B. Applying underwriting criteria inconsistently based on personal biases. C. Providing policyholders with clear and transparent information about policy terms. D. Discriminating against applicants based on protected characteristics such as race or gender. The correct answer: C. Providing policyholders with clear and transparent information about policy terms. Explanation: providing policyholders with clear and transparent information about policy terms is a key consideration in ethical underwriting practices. Ethical underwriters prioritize transparency and honesty in their communications with policyholders, ensuring that they fully understand the terms, conditions, and limitations of their insurance policies. Maximizing profitability by minimizing coverage, applying underwriting criteria inconsistently, or discriminating against applicants based on protected characteristics are all unethical practices that violate the principles of fairness, integrity, and non-discrimination. Ethical underwriters must adhere to strict ethical standards and treat all applicants fairly and equitably in the underwriting process. Question 82. Which of the following scenarios illustrates unethical behavior in claims handling? A. Processing claims promptly and efficiently to ensure policyholders receive benefits in a timely manner. B. Denying a claim based on legitimate policy exclusions and providing clear explanations to the policyholder. C. Adjusting a claim payout based on the policyholder's ethnicity rather than the actual loss incurred. D. Offering policyholders options for additional coverage to meet their evolving needs. The correct answer: C. Adjusting a claim payout based on the policyholder's ethnicity rather than the actual loss incurred. Explanation: adjusting a claim payout based on the policyholder's ethnicity rather than the actual loss incurred is unethical behavior in claims handling. Ethical claims handling practices require claims adjusters to assess claims objectively and determine payouts based solely on the terms and conditions of the insurance policy and the actual loss experienced by the policyholder. Discriminating against policyholders based on protected characteristics such as ethnicity violates ethical principles of fairness and non-discrimination. Insurance companies have a duty to treat all policyholders fairly and impartially, regardless of their personal characteristics or backgrounds. Question 83. Ms. Garcia, an underwriter, approves an insurance application without verifying the accuracy of the applicant's medical history. Which ethical principle is Ms. Garcia violating? A. Transparency. B. Competence. C. Confidentiality. D. Fiduciary duty. The correct answer: B. Competence. Explanation: by approving an insurance application without verifying the accuracy of the applicant's medical history, Ms. Garcia is violating the ethical principle of competence. Competence requires underwriters to possess the knowledge, skills, and expertise necessary to assess risks accurately and make informed underwriting decisions. Failing to verify the accuracy of the applicant's medical history can lead to adverse selection and financial losses for the insurance company. Underwriters have a duty to conduct thorough evaluations of applicants' risk profiles and ensure that policyholders are accurately assessed based on relevant underwriting criteria. Question 84. Which of the following is not a key consideration in ethical claims handling practices? A. Prompt and fair resolution of claims. B. Transparent communication with policyholders about claim decisions. C. Minimizing claim payouts to maximize profitability for the insurance company. D. Impartial assessment of claims based on policy terms and coverage. The correct answer: C. Minimizing claim payouts to maximize profitability for the insurance company. Explanation: minimizing claim payouts to maximize profitability for the insurance company is not a key consideration in ethical claims handling practices. Ethical claims handling practices prioritize the prompt and fair resolution of claims, transparent communication with policyholders about claim decisions, and impartial assessment of claims based on policy terms and coverage. Insurance companies have a duty to honor the commitments made to policyholders and pay valid claims promptly and fairly. Ethical claims handling practices ensure that policyholders receive the benefits they are entitled to under their insurance policies and maintain trust and confidence in the insurance industry. Question 85. Which of the following actions by an insurance company would be considered unethical in underwriting? A. Reviewing an applicant's medical records to accurately assess their health status. B. Denying coverage to an applicant based on their race or ethnicity. C. Offering discounted premiums to applicants who maintain a healthy lifestyle. D. Assessing applicants' risk factors to determine appropriate coverage and premiums. The correct answer: B. Denying coverage to an applicant based on their race or ethnicity. Explanation: denying coverage to an applicant based on their race or ethnicity is unethical in underwriting. Ethical underwriting practices require insurers to evaluate applicants based on relevant risk factors such as health status, lifestyle, and occupation, rather than personal characteristics such as race or ethnicity. Discriminating against applicants based on protected characteristics violates ethical principles of fairness and non-discrimination. Insurance companies have a duty to treat all applicants fairly and assess their risk profiles objectively to determine appropriate coverage and premiums. Question 86. Mr. Thompson, a claims adjuster, approves a claim without verifying the extent of the policyholder's loss. Which ethical principle is Mr. Thompson violating? A. Integrity. B. Fairness. C. Competence. D. Fiduciary duty. The correct answer: C. Competence. Explanation: by approving a claim without verifying the extent of the policyholder's loss, Mr. Thompson is violating the ethical principle of competence. Competence requires claims adjusters to possess the knowledge, skills, and expertise necessary to assess claims accurately and make informed decisions. Failing to verify the extent of the policyholder's loss can lead to incorrect claim payouts and financial losses for the insurance company. Claims adjusters have a duty to conduct thorough investigations and ensure that claim payouts are based on the actual losses incurred by the policyholder. Question 87. Which of the following situations would not represent a conflict of interest in insurance sales and recommendations? A. An insurance agent recommending a policy from an affiliated company without disclosing the affiliation. B. An insurance broker advising a client to purchase a policy that offers higher commissions to the broker. C. An insurance company offering incentives to agents for selling specific insurance products. D. An insurance agent recommending a policy solely based on the client's needs and financial situation. The correct answer: D. An insurance agent recommending a policy solely based on the client's needs and financial situation. Explanation: in the context of insurance sales and recommendations, a conflict of interest arises when the agent or broker's personal interests conflict with their duty to act in the client's best interests. Options A, B, and C all involve situations where personal interests, such as financial incentives or affiliations, could influence the recommendation of insurance products. However, Option D represents an ethical practice where the recommendation is solely based on the client's needs and financial situation, without any conflicting interests. Question 88. Ms. Smith, an insurance agent, recommends a whole life insurance policy to her client, Mr. Johnson, without disclosing that she will receive higher commissions for selling this policy compared to other available options. Which ethical principle is Ms. Smith violating? A. Transparency. B. Integrity. C. Loyalty. D. Competence. The correct answer: A. Transparency. Explanation: By failing to disclose her potential conflict of interest regarding the higher commissions associated with the recommended policy, Ms. Smith is violating the ethical principle of transparency. Transparency requires agents to disclose any conflicts of interest that may affect their recommendations, allowing clients to make informed decisions about their insurance coverage. Failing to disclose such conflicts can undermine the trust and confidence of clients in the agent-client relationship. Question 89. Which of the following actions by an insurance agent would constitute a conflict of interest? A. Providing clients with objective information about various insurance products. B. Accepting gifts from insurance companies in exchange for promoting their products. C. Recommending a policy that offers the highest benefits to the client. D. Disclosing to clients any potential conflicts of interest before making recommendations. The correct answer, B. Accepting gifts from insurance companies in exchange for promoting their products. Explanation. Accepting gifts from insurance companies in exchange for promoting their products would constitute a conflict of interest for an insurance agent. This action may bias the agent's recommendations and compromise their objectivity in advising clients. Ethical standards require agents to prioritize the interests of their clients above their own financial gain or incentives from insurance companies. Accepting gifts without disclosure can erode trust and integrity in the agent-client relationship. Question 90. Which of the following situations would most likely result in a conflict of interest for an insurance agent? A. Recommending a policy from an insurance company with a strong financial rating. B. Disclosing to clients the commissions earned by selling different insurance products. C. Accepting a referral fee from a third party for recommending their insurance product. D. Providing clients with a range of insurance options tailored to their needs. The correct answer, C. Accepting a referral fee from a third party for recommending their insurance product. Explanation. Accepting a referral fee from a third party for recommending their insurance product would likely result in a conflict of interest for an insurance agent. In this scenario, the agent's financial interest in receiving the referral fee may influence their recommendation, potentially leading them to prioritize their own interests over those of the client. Such conflicts should be disclosed to clients to ensure transparency and informed decision-making. Question 91. Mr. Davis, an insurance agent, recommends a higher coverage policy to a client, Mrs. Rodriguez, even though a lower coverage option would adequately meet her needs. The higher coverage policy offers Mr. Davis a higher commission. Which ethical principle is Mr. Davis violating? A. Integrity. B. Transparency. C. Competence. D. Loyalty. The correct answer, B. Transparency. Explanation. By recommending a higher coverage policy to Mrs. Rodriguez without disclosing his financial interest in the form of a higher commission, Mr. Davis is violating the ethical principle of transparency. Transparency requires agents to disclose any conflicts of interest that may influence their recommendations, allowing clients to make fully informed decisions. Failing to disclose such conflicts undermines trust and integrity in the agent-client relationship. Question 92. Which of the following actions by an insurance agent would be considered ethical in managing conflicts of interest? A. Providing biased information that favors insurance products from affiliated companies. B. Recommending insurance products solely based on their potential to generate higher commissions. C. Disclosing to clients any financial incentives or affiliations that may influence their recommendations. D. Steering clients away from insurance products that offer lower commissions. The correct answer, C. Disclosing to clients any financial incentives or affiliations that may influence their recommendations. Explanation. Disclosing to clients any financial incentives or affiliations that may influence their recommendations is considered ethical in managing conflicts of interest. Transparency and disclosure allow clients to make informed decisions about their insurance coverage, knowing the potential influences on the recommendations provided by the agent. This practice builds trust and confidence in the agent-client relationship and ensures that the client's best interests are prioritized. Question 93. Which of the following scenarios represents a conflict of interest for an insurance broker? A. Offering clients unbiased advice on insurance products from multiple insurance companies. B. Accepting a referral fee from an insurance company for directing clients to purchase their products. C. Disclosing to clients the commissions earned on the sale of insurance policies. D. Recommending insurance products solely based on their suitability to the client's needs. The correct answer, B. Accepting a referral fee from an insurance company for directing clients to purchase their products. Explanation. Accepting a referral fee from an insurance company for directing clients to purchase their products would represent a conflict of interest for an insurance broker. In this scenario, the broker's financial incentive may influence their recommendation, potentially leading to biased advice. It is essential for brokers to prioritize their clients' interests over their own financial gain and avoid situations where their recommendations are influenced by referral fees. Question 94. Ms. Thompson, an insurance agent, recommends a policy to her client, Mr. Lee, which provides lower coverage than other available options. Ms. Thompson fails to disclose that she will receive higher commissions for selling this particular policy. Which ethical principle is Ms. Thompson violating? A. Loyalty. B. Competence. C. Transparency. D. Fiduciary duty. The correct answer, C. Transparency. Explanation. By failing to disclose her potential conflict of interest regarding the higher commissions associated with the recommended policy, Ms. Thompson is violating the ethical principle of transparency. Transparency requires agents to disclose any conflicts of interest that may affect their recommendations, allowing clients to make fully informed decisions about their insurance coverage. Failing to disclose such conflicts undermines trust and confidence in the agent-client relationship. Question 95. Which of the following actions by an insurance agent would not constitute a conflict of interest? A. Offering clients options from multiple insurance companies to compare and choose from. B. Accepting gifts from clients as a token of appreciation for their assistance. C. Disclosing any financial incentives received for recommending specific insurance products. D. Steering clients towards insurance products from affiliated companies without disclosure. The correct answer, A. Offering clients options from multiple insurance companies to compare and choose from. Explanation. Offering clients options from multiple insurance companies to compare and choose from would not constitute a conflict of interest. In fact, providing clients with a variety of choices promotes transparency and enables clients to make informed decisions based on their needs and preferences. Options B, C, and D involve situations where conflicts of interest may arise due to financial incentives, gifts, or biased recommendations. Question 96. Which of the following actions by an insurance agent would be considered unethical due to a conflict of interest? A. Providing clients with unbiased information about insurance products from various companies. B. Recommending insurance policies solely based on the client's needs and financial situation. C. Accepting kickbacks from insurance companies in exchange for promoting their products. D. Disclosing to clients any financial incentives or affiliations that may influence their recommendations. The correct answer, C. Accepting kickbacks from insurance companies in exchange for promoting their products. Explanation. Accepting kickbacks from insurance companies in exchange for promoting their products represents a conflict of interest and is unethical. It can lead to biased recommendations that prioritize the agent's financial gain over the client's best interests. Agents have a duty to act in the best interests of their clients and provide objective advice, free from financial incentives that could compromise their recommendations. Question 97. Mr. Garcia, an insurance agent, recommends a policy with higher premiums to his client, Ms. Patel, without disclosing that he will receive higher commissions for selling this policy. Which ethical principle is Mr. Garcia violating? A. Competence. B. Transparency. C. Fiduciary duty. D. Integrity. The correct answer, B. Transparency. Explanation. By failing to disclose his potential conflict of interest regarding the higher commissions associated with the recommended policy, Mr. Garcia is violating the ethical principle of transparency. Transparency requires agents to disclose any conflicts of interest that may affect their recommendations, allowing clients to make fully informed decisions about their insurance coverage. Failing to disclose such conflicts undermines trust and confidence in the agent-client relationship. Question 98. Which of the following actions by an insurance broker would constitute a conflict of interest? A. Recommending insurance products that offer the best coverage options for clients. B. Accepting referral fees from multiple insurance companies for directing clients to purchase their products. C. Disclosing to clients any financial interests or affiliations that may influence their recommendations. D. Offering clients discounted premiums on insurance policies from affiliated companies. The correct answer: D. Offering clients discounted premiums on insurance policies from affiliated companies. Explanation. Offering clients discounted premiums on insurance policies from affiliated companies would constitute a conflict of interest for an insurance broker. This practice may bias the broker's recommendations and prioritize the interests of affiliated companies over the best interests of the clients. Brokers have a duty to provide objective advice and avoid situations where their recommendations are influenced by financial incentives or affiliations. Question 99. Which of the following actions by an insurance agent would be considered unethical in terms of professional conduct? A. Providing clients with clear and transparent information about policy terms and coverage. B. Falsifying information on insurance applications to secure coverage for clients. C. Disclosing to clients any potential conflicts of interest that may influence their recommendations. D. Continuously updating knowledge and skills through continuing education programs. The correct answer: B. Falsifying information on insurance applications to secure coverage for clients. Explanation. Falsifying information on insurance applications to secure coverage for clients is unethical and violates professional conduct standards. Insurance agents have a duty to act with honesty and integrity, and providing false information undermines trust in the insurance industry. Clients rely on agents to accurately represent their interests and provide truthful information to insurance companies. Falsifying information can lead to legal consequences and damage the reputation of the agent and the insurance company. Question 100. Ms. Adams, an insurance agent, is approached by a client who wants to cancel their policy. The client is experiencing financial difficulties and cannot afford the premiums. What should Ms. Adams do in this situation? A. Persuade the client to keep the policy and maintain coverage. B. Encourage the client to explore alternative options for reducing premiums or adjusting coverage. C. Respect the client's decision to cancel the policy and assist them in the cancellation process. D. Suggest that the client borrow money to continue paying the premiums. The correct answer: C. Respect the client's decision to cancel the policy and assist them in the cancellation process. Explanation. In this situation, the ethical course of action for Ms. Adams is to respect the client's decision to cancel the policy and assist them in the cancellation process. Insurance agents have a duty to act in the best interests of their clients, which includes respecting their autonomy and decisions regarding their insurance coverage. Ms. Adams should provide support and guidance to the client in navigating the cancellation process and exploring alternative options if necessary. Question 101. Which of the following principles is not part of ethical behavior in the insurance industry? A. Integrity. B. Confidentiality. C. Loyalty to the insurance company. D. Professional competence. The correct answer: C. Loyalty to the insurance company. Explanation. While loyalty to the insurance company is important for agents to fulfill their contractual obligations and represent the company's interests, it is not the primary focus of ethical behavior in the insurance industry. Instead, ethical behavior centers on principles such as integrity, confidentiality, and professional competence. Agents have a fiduciary duty to act in the best interests of their clients, which may sometimes require balancing loyalty to the company with loyalty to the client's interests. Question 102. Which of the following actions by an insurance agent demonstrates a breach of confidentiality? A. Sharing policy information with the client's authorized representatives. B. Disclosing policy details to law enforcement authorities with a valid warrant. C. Discussing a client's insurance coverage details with a friend for personal gain. D. Providing policy information to the insurance company's underwriters for assessment. The correct answer: C. Discussing a client's insurance coverage details with a friend for personal gain. Explanation: discussing a client's insurance coverage details with a friend for personal gain constitutes a breach of confidentiality. Insurance agents have a duty to maintain the confidentiality of their clients' information and only disclose it to authorized parties for legitimate purposes, such as providing services or fulfilling legal obligations. Sharing sensitive information with unauthorized individuals for personal gain violates professional conduct standards and erodes trust in the agent-client relationship. Question 103. Mr. Roberts, an insurance agent, encounters a situation where a client's insurance claim is denied due to a technicality in the policy wording. However, Mr. Roberts believes the claim is valid and should be paid. What should Mr. Roberts do in this situation? A. Inform the client about the denial and explain the reasons provided by the insurance company. B. Advocate on behalf of the client to the insurance company and request a review of the claim denial. C. Accept the claim denial and advise the client to seek legal action against the insurance company. D. Persuade the client to drop the claim and consider purchasing a different insurance policy. The correct answer: B. Advocate on behalf of the client to the insurance company and request a review of the claim denial. Explanation: in this situation, Mr. Roberts should advocate on behalf of the client to the insurance company and request a review of the claim denial. As an insurance agent, Mr. Roberts has a duty to act in the best interests of his clients and ensure they receive fair treatment from the insurance company. Advocating for the client involves presenting evidence and arguments supporting the validity of the claim and seeking a reconsideration of the denial. This action demonstrates ethical conduct by prioritizing the client's interests and working to achieve a fair resolution. Question 104. Which of the following is not a characteristic of professional competence for insurance agents? A. Keeping abreast of industry developments and regulatory changes. B. Providing accurate and up-to-date information to clients. C. Adhering strictly to company policies, even if they conflict with ethical standards. D. Continuously improving knowledge and skills through training and education. The correct answer: C. Adhering strictly to company policies, even if they conflict with ethical standards. Explanation: adhering strictly to company policies, even if they conflict with ethical standards, is not a characteristic of professional competence for insurance agents. Professional competence involves possessing the knowledge, skills, and expertise necessary to serve clients effectively while adhering to ethical principles and regulatory requirements. Agents should exercise judgment and discretion in applying company policies, ensuring they align with ethical standards and prioritize the interests of their clients. Compliance with ethical standards takes precedence over strict adherence to company policies when conflicts arise. Question 105. Which of the following is not an effective measure for preventing insurance fraud? A. Implementing strict underwriting guidelines and verification processes. B. Conducting regular audits and reviews of insurance claims and policyholder information. C. Encouraging policyholders to withhold information about pre-existing conditions to lower premiums. D. Providing comprehensive training to insurance agents and employees on detecting fraudulent activities. The correct answer: C. Encouraging policyholders to withhold information about pre-existing conditions to lower premiums. Explanation: encouraging policyholders to withhold information about pre-existing conditions to lower premiums is not an effective measure for preventing insurance fraud. In fact, Such actions contribute to fraud by misrepresenting the risk to the insurer and distorting the underwriting process. Effective fraud prevention measures focus on implementing strict underwriting guidelines, conducting audits and reviews, and providing training to identify and deter fraudulent activities within the insurance industry. Question 106. Which of the following is an example of insurance fraud? A. A policyholder accidentally provides incorrect information on their insurance application. B. An insurance agent advises a client to inflate their claim to receive a higher payout. C. A policyholder files a legitimate claim for damages covered under their insurance policy. D. An insurance company denies a claim due to a technicality in the policy wording. The correct answer, B. An insurance agent advises a client to inflate their claim to receive a higher payout. Explanation. An insurance agent advising a client to inflate their claim to receive a higher payout constitutes insurance fraud. Fraudulent activities can involve various parties, including policyholders, agents, and employees, and may include actions such as exaggerating losses, staging accidents, or submitting false documentation. Insurance fraud increases costs for insurers and policyholders and undermines the integrity of the insurance system. Question 107. Which of the following best describes the role of data analytics in insurance fraud detection? A. Identifying potential fraud indicators based on historical claims data and patterns. B. Rejecting all insurance claims that deviate from the average claim amount. C. Randomly auditing a small percentage of insurance claims without analyzing data. D. Using manual processes to review insurance claims for potential fraud. The correct answer, A. Identifying potential fraud indicators based on historical claims data and patterns. Explanation. Data analytics plays a crucial role in insurance fraud detection by identifying potential fraud indicators based on historical claims data and patterns. Advanced analytics techniques, such as predictive modeling and anomaly detection, enable insurers to analyze large volumes of data to detect suspicious patterns or behaviors indicative of fraud. By leveraging data analytics, insurers can enhance their ability to detect and prevent fraudulent activities, ultimately protecting the interests of policyholders and maintaining the integrity of the insurance system. Question 108. Which of the following is a red flag for potential insurance fraud? A. A policyholder regularly updating their contact information with the insurance company. B. A sudden increase in the number of insurance claims filed by a policyholder. C. A policyholder providing accurate and consistent information on their insurance application. D. A policyholder purchasing additional coverage to protect their assets. The correct answer, B. A sudden increase in the number of insurance claims filed by a policyholder. Explanation. A sudden increase in the number of insurance claims filed by a policyholder is a red flag for potential insurance fraud. It may indicate a pattern of suspicious behavior, such as intentionally causing losses or exaggerating claims to receive undue benefits. Insurers should investigate such cases thoroughly, including reviewing claim documentation and conducting interviews with the policyholder to determine the legitimacy of the claims and identify any fraudulent activities. Question 109. Which of the following is an example of insurance fraud committed by an insurance company? A. Denying a claim based on valid policy exclusions and limitations. B. Providing accurate and transparent information to policyholders about coverage. C. Altering claim documents to reduce the amount payable to the policyholder. D. Adhering to regulatory requirements and industry standards in claims processing. The correct answer, C. Altering claim documents to reduce the amount payable to the policyholder. Explanation. Altering claim documents to reduce the amount payable to the policyholder constitutes insurance fraud committed by an insurance company. This action undermines the integrity of the claims process and violates the insurer's duty to act in good faith and deal fairly with policyholders. Insurance companies have a responsibility to process claims accurately and fairly, ensuring that policyholders receive the benefits they are entitled to under their insurance policies. Question 110. Which of the following measures can help prevent identity theft-related insurance fraud? A. Verifying the identity of policyholders through biometric authentication methods. B. Sharing policyholder information with third-party marketing agencies for promotional purposes. C. Allowing policyholders to access their insurance accounts from public Wi-Fi networks. D. Disclosing policyholder personal information on social media platforms. The correct answer: A. Verifying the identity of policyholders through biometric authentication methods. Explanation: Verifying the identity of policyholders through biometric authentication methods can help prevent identity theft-related insurance fraud. Biometric authentication, such as fingerprint or facial recognition, provides a secure way to confirm the identity of individuals accessing insurance accounts or submitting claims online. By implementing strong identity verification measures, insurers can reduce the risk of fraudulent activities, safeguard policyholder information, and enhance the overall security of their systems. Question 111. Which of the following actions can help insurance companies detect fraudulent claims? A. Implementing lenient claims processing procedures to expedite payments. B. Conducting thorough investigations into claims that deviate from typical patterns. C. Automatically approving all claims submitted by long-standing policyholders. D. Outsourcing claims handling to third-party companies without oversight. The correct answer: B. Conducting thorough investigations into claims that deviate from typical patterns. Explanation: Conducting thorough investigations into claims that deviate from typical patterns can help insurance companies detect fraudulent claims. By analyzing claim data and identifying discrepancies or red flags, insurers can prioritize investigations into suspicious claims to determine their legitimacy. Implementing rigorous claims processing procedures and conducting detailed investigations are essential components of effective fraud detection strategies in the insurance industry. Question 112. Which of the following is an example of soft fraud in insurance? A. A policyholder intentionally causes damage to their property to file a claim. B. A policyholder provides inaccurate information on their insurance application. C. A policyholder exaggerates the extent of injuries sustained in an accident. D. A policyholder fails to disclose previous insurance claims when applying for coverage. The correct answer: D. A policyholder fails to disclose previous insurance claims when applying for coverage. Explanation: A policyholder failing to disclose previous insurance claims when applying for coverage is an example of soft fraud in insurance. Soft fraud involves misrepresenting information or omitting relevant details to obtain insurance benefits to which one may not be entitled. While the action may not involve deliberate fabrication of claims, it still constitutes fraud and undermines the integrity of the insurance system. Question 113. Which of the following is a common method used to commit health insurance fraud? A. Overstating the severity of medical conditions to obtain higher coverage limits. B. Providing accurate and complete information on insurance applications. C. Adhering to physician-recommended treatment plans and procedures. D. Maintaining open communication with insurance companies about changes in health status. The correct answer: A. Overstating the severity of medical conditions to obtain higher coverage limits. Explanation: Overstating the severity of medical conditions to obtain higher coverage limits is a common method used to commit health insurance fraud. This action involves intentionally exaggerating or falsifying medical information to receive more extensive coverage or higher benefits than warranted by the actual condition. Health insurance fraud can result in increased costs for insurers, higher premiums for policyholders, and compromised access to healthcare services for those in genuine need. Question 114. Which of the following statements accurately describes the role of state insurance regulators in the regulation of insurance rates and forms? A. State insurance regulators have no authority over insurance rates and forms, as they are solely determined by insurance companies. B. State insurance regulators have the authority to set uniform insurance rates and forms for all insurance companies operating within the state. C. State insurance regulators review and approve insurance rates and forms to ensure they are fair, reasonable, and not unfairly discriminatory. D. State insurance regulators only regulate insurance rates but not the forms used by insurance companies. The correct answer, C. State insurance regulators review and approve insurance rates and forms to ensure they are fair, reasonable, and not unfairly discriminatory. Explanation. State insurance regulators play a critical role in the regulation of insurance rates and forms by reviewing and approving them to ensure they are fair, reasonable, and not unfairly discriminatory. Insurance companies must submit their proposed rates and forms to state regulators for approval before they can be used. Regulators evaluate factors such as risk, market conditions, and actuarial principles to determine whether the proposed rates are justified and whether the forms comply with state laws and regulations. Question 115. Which of the following factors may influence the approval of insurance rates and forms by state insurance regulators? A. The insurance company's financial performance and profitability. B. Public input and feedback on proposed rates and forms. C. The size and market share of the insurance company. D. The political affiliations of the insurance company's executives. The correct answer, B. Public input and feedback on proposed rates and forms. Explanation. Public input and feedback on proposed rates and forms may influence the approval process by state insurance regulators. Regulators often solicit input from stakeholders, including policyholders, consumer advocacy groups, and industry experts, to assess the potential impact of proposed rates and forms on consumers and the insurance market. Public scrutiny and feedback help ensure transparency and accountability in the regulatory process and may prompt regulators to reconsider or modify their decisions based on public concerns. Question 116. Which of the following statements accurately reflects the concept of rate discrimination in insurance regulation? A. Rate discrimination is prohibited in all circumstances and is considered unethical by state insurance regulators. B. Rate discrimination occurs when insurance companies charge different rates to policyholders based on their risk characteristics. C. Rate discrimination is only permitted if it benefits policyholders with higher risk profiles. D. Rate discrimination refers to the practice of insurance companies setting rates without considering policyholder risk characteristics. The correct answer, B. Rate discrimination occurs when insurance companies charge different rates to policyholders based on their risk characteristics. Explanation. Rate discrimination occurs when insurance companies charge different rates to policyholders based on their risk characteristics. State insurance regulators permit rate differentiation based on risk factors such as age, gender, occupation, and health status, as long as the differentiation is actuarially justified and not unfairly discriminatory. Regulators aim to strike a balance between ensuring affordability and accessibility of insurance while allowing insurers to accurately price risk based on individual characteristics. Question 117. Which of the following best describes the purpose of rate filings submitted by insurance companies to state insurance regulators? A. To establish uniform rates for all insurance products across different states. B. To justify proposed insurance rates and demonstrate compliance with state laws and regulations. C. To bypass state regulations and set rates independently based on market demand. D. To provide estimates of potential losses and profits to shareholders and investors. The correct answer, B. To justify proposed insurance rates and demonstrate compliance with state laws and regulations. Explanation. Insurance companies submit rate filings to state insurance regulators to justify proposed insurance rates and demonstrate compliance with state laws and regulations. Rate filings include detailed information about the factors influencing the proposed rates, such as actuarial calculations, risk assessments, and market conditions. Regulators review these filings to ensure that the proposed rates are fair, reasonable, and not unfairly discriminatory. Rate filings are essential for transparency and accountability in the regulatory process. Question 118. What is the primary role of the Indiana Department of Insurance in regulating the insurance industry? A. Enforcing insurance premiums. B. Marketing insurance products. C. Licensing insurance agents. D. Conducting market research. The correct answer is C. Licensing insurance agents. Explanation. The Indiana Department of Insurance plays a crucial role in regulating the insurance industry within the state. One of its primary functions is the licensing of insurance agents. Before agents can legally sell insurance products to consumers in Indiana, they must obtain the appropriate license from the department. This ensures that agents meet certain standards of competency and professionalism, thereby protecting consumers from unqualified or fraudulent individuals. Additionally, the department oversees the education and training requirements for insurance agents, ensuring they possess the necessary knowledge to ethically and effectively serve their clients. By licensing insurance agents, the department helps maintain the integrity and stability of the insurance market in Indiana, fostering trust between insurers, agents, and policyholders. While the department may also be involved in other activities such as market research and enforcement of insurance laws, its primary focus is on licensing and regulating insurance agents to safeguard the interests of consumers and maintain the integrity of the insurance industry. Question 119. In what ways does the Indiana Department of Insurance protect policyholders? A. By setting insurance premiums. B. By investigating insurance claims. C. By marketing insurance products. D. By regulating insurance agents. The correct answer is B. By investigating insurance claims. Explanation. The Indiana Department of Insurance serves to protect policyholders by overseeing various aspects of the insurance industry. One important way it achieves this is by investigating insurance claims. When policyholders file claims with their insurance companies, they expect fair treatment and timely resolution. The department helps ensure this by investigating complaints and disputes related to insurance claims. Through its investigative process, the department assesses whether insurance companies are fulfilling their contractual obligations to policyholders. This includes evaluating claim denials, delays, or disputes to determine if they comply with Indiana insurance laws and regulations. By holding insurers accountable for their claims handling practices, the department helps protect policyholders from unfair treatment and ensures they receive the benefits they are entitled to under their insurance policies. While the department is not directly involved in setting insurance premiums or marketing insurance products, its oversight of insurance claims processes is essential for upholding the rights of policyholders and maintaining the integrity of the insurance market in Indiana. Question 120. How does the Indiana Department of Insurance promote consumer education and awareness? A. By investing in insurance companies. B. By regulating insurance premiums. C. By providing resources and information. D. By marketing insurance products. The correct answer is C. By providing resources and information. Explanation. The Indiana Department of Insurance plays a vital role in promoting consumer education and awareness within the state. One of the ways it achieves this is by providing resources and information to help consumers make informed decisions about insurance matters. The department offers various educational materials, such as brochures, guides, and online resources, to help consumers understand their rights and responsibilities regarding insurance. These resources cover topics such as insurance policies, coverage options, claims processes, and rights under Indiana insurance laws. By providing clear and accessible information, the department empowers consumers to navigate the complexities of the insurance industry confidently. Furthermore, the department may offer workshops, seminars, or outreach programs to educate consumers on specific insurance-related topics or emerging issues. These educational initiatives aim to increase awareness about insurance products, consumer rights, and ways to protect against insurance fraud or abuse. By promoting consumer education and awareness, the Indiana Department of Insurance helps individuals make informed choices when purchasing insurance, thereby fostering a more transparent and equitable insurance market for all stakeholders.